Most people, when they think of the Federal Reserve, imagine a building of marble and power in Washington, a place where decisions about money flow down from on high. But the truth is far quieter than that, far more human. The story of how America came to have a central bank, the institution that would shape a nation's financial breath for over a century, began not in America at all, but in the fog-wrapped streets of a German port city, in the counting houses and candle-lit offices of a family whose name you might never have heard, the Warburgs. And their journey is not one of lightning-strike ambition or ruthless conquest, but something more subtle, the slow, patient accumulation of trust, knowledge, and an almost stubborn belief that money, at its root, is simply a language between people. Picture, if you will, a late autumn evening in Hamburg, 1880. The kind of dusk that settles early over a northern city, when the light drains from the sky like water from a basin. The Ulster canals, those quiet waterways that wind through the merchant quarter, are beginning to disappear beneath a gathering fog. Wisps of it rise from the water's surface, soft and patient, curling around the facades of the banking houses and warehouses that line the streets. The buildings themselves are old, some of them centuries old, their brick the color of dried blood and clay, their windows narrow and deep-set, like eyes that have seen innumerable transactions, innumerable fortunes rise and fall. The gaslight is just being lit. You can imagine it, the soft percussion of the lamplighter's pole striking the ignition mechanism, the sudden bloom of pale yellow flame inside each globe, spreading a gentle, amber-tinted circle on the damp pavement below. The gas hisses almost imperceptibly, a sound so familiar to the people who live here that they no longer truly hear it. It is the sound of their world, steady and reliable as breath. Inside the Warburg Company banking house, modest from the outside, but inside filled with the accumulated tools of centuries of careful finance, the day is drawing to a close. The junior clerks are putting away their ledgers, those massive leather-bound books in which every transaction, every promissory note, every letter of credit has been entered in an elegant, meticulous hand. Rows and rows of them, arranged on shelves that climb toward the high ceilings. The ink has dried, the pages have been turned, the day's business has been recorded, verified, and filed. There is a particular kind of quietness that falls over a counting house at the close of day, especially in autumn, especially in a city like Hamburg. It is not quite silence, because silence implies the absence of sound. This is something subtler. It is the sound of deliberateness slowing. The scratch of pen nibs ceases. The rustle of papers subsides. The soft footfalls of clerks moving between desks grow fewer and fewer, until eventually even those fade. What remains is the ambient hum of a building at rest, the settling of wood, the whisper of the gaslight, the distant, muffled sound of the city beyond these walls. The partners of the bank, those men who bear the family name, or who have married into it, are still present, though not in any hurried way. They move through the corridors with the ease of people entirely at home in their surroundings. A ledger is consulted one final time. A letter is reviewed. A decision, perhaps, is made regarding some distant transaction, some cargo that left port weeks ago and will not return until spring. These men are accustomed to thinking in such timescales, weeks, months, years. They understand that money is not quick, despite what most people imagine. Money is patient. It requires faith. This is the world into which we are entering, not the world of dramatic crashes or wild speculation, though those will come. Not the world of sudden wealth or failure, though those too will find their way into this story, but rather the foundational world, the world of slow accumulation, of careful reputation, of ledgers and trust, and the peculiar alchemy by which human beings agree to honor one another's promises. If you have ever wondered how a family of immigrants to a German city came to reshape the financial architecture of an entire nation across an ocean, how they were the quiet architects of the very institution that still governs the flow of money through American life, then I invite you to stay with us as we follow the Warburgs across generations and continents, through prosperity and exile, and into the heart of one of history's most misunderstood institutions. If you would like to journey with us through this story, subscribe to hear how one family's flight from persecution became the foundation of modern central banking. The fog deepens outside. The lamplights flicker slightly as wind comes off the canals, and inside those banking houses, the ledgers rest in their places, waiting for tomorrow's entries. But the story of the Warburgs does not begin tomorrow. It begins much earlier, in a past so distant that it almost feels like legend. It begins with a name and a question. Where did these people come from, and how did they come to matter so greatly in the architecture of the modern world? To understand the Warburgs, you must first understand that they were not always bankers in Hamburg. They were, in fact, wanderers. Their name itself carries the geography of their earliest movements. Some historians trace it back to Bologna, that ancient center of medieval finance, where Jewish merchants and moneylenders first began to formalize the practices that would eventually become modern banking. Others point to Venice, that republic of merchant princes, where the Warburgs, or something close to that name, may have moved money and goods across the Mediterranean as the great age of trade was beginning to reshape Europe. But these are distant echoes. The more certain history is this. By the 17th century, members of the family had settled in Hamburg, not as a permanent resting place perhaps, but as a base, as a city that made sense. Hamburg was a port, and ports are the natural homes for merchants. They are places where money flows, where goods arrive from all corners of the world, where trust becomes currency, because you are doing business with people you have never met and may never meet again. If you want to be a merchant in such a place, you must cultivate reputation as carefully as a farmer cultivates soil. One broken promise, one shipment that goes missing, one debt that is not repaid, and your name loses its currency. This was the world the Warburgs entered, and it was the world that would shape them, perhaps more profoundly than they shaped it in return. They were not revolutionary. They did not invent banking. They did nothing to overturn the established order of things. What they did was something quieter, and in the long run more powerful. They became trustworthy. They became reliable. They became the kind of family to whom others would entrust their money, knowing that it would be cared for, multiplied, returned to them with profit, and never lost to sudden impulse or dishonesty. And in doing so, in the simple, patient accumulation of that trust across generations, within the narrow canals and gaslit streets of Hamburg, within the leather bindings of those perpetually growing ledgers, they began to build something that would eventually, improbably, change the financial life of a continent. What you're about to hear is not simply the history of a bank. It is the story of a family whose decisions, made in quiet rooms and hushed conversations, would eventually reshape the financial architecture of a nation. The Warburgs were not merely witnesses to the great turning points of the 20th century. They were, in many ways, woven into them, though their presence was often felt more than seen, their influence quieter than the headlines that surrounded them. This journey will take us from the gaslit streets of medieval Hamburg, where the family first learned to move money across borders and build trust in an uncertain world, all the way to the corridors of American power during moments of national crisis. We will follow 5 brothers as they inherited not just a banking house, but a legacy of service and responsibility that neither money nor geography could easily untangle. We will watch as one among them, Paul, traveled westward to a nation that distrusted banks almost as much as it distrusted foreigners, and there found himself at the center of events that would define how America thinks about money, credit, and collective security to this day. But this is also a story about what happens when the world convulses. It is about a family forced to choose between survival and principle, between holding on to what they had built and fleeing across oceans to save their lives. The Warburgs would experience triumphant moments of influence and devastating moments of loss. They would watch empires rise and fall. They would see the banking system they helped create tested in ways they could never have imagined. And through it all, they remained bound to one another by something deeper than contracts or ledgers, a sense that their work mattered, that careful stewardship of capital and trust could serve the greater good. If you find yourself drawn to stories about how power really works, about the quiet decisions that shape nations, about families caught between loyalty and survival, and about the strange, almost invisible machinery that makes modern finance possible, then I invite you to follow this family saga through the decades and across the continents that claimed them. Subscribe to stay with the Warburgs as they navigate exile, war, prosperity, and the slow unraveling of everything they thought was secure. What makes this story so strangely compelling is that it plays out at the intersection of intimate family life and sweeping historical events. The personal and the political are inseparable here. When you read a letter from Paul Warburg to his brothers during the First World War, separated as they were by lines of battle, you are not reading merely a family's correspondence. You are reading the anxiety of a whole era, the collision of loyalties that tore families and nations apart. When you learn about the birth of the Federal Reserve System in the early morning hours of a secret meeting on an island off the coast of Georgia, you are learning not just about banking theory, but about how power brokers in a democracy sometimes find it necessary to work in shadow when broad daylight seems impossible. The Warburgs were Jewish bankers in an era when that identity carried weight both as an advantage and as a profound vulnerability. They were internationalists in an age of rising nationalism. They believed in rational economic systems at moments when fear and fury often drove policy. And they were exiles before exile became a common human experience. Though their flight, when it came, was forced upon them by hatred and the machinery of persecution rather than chosen as an adventure or a business opportunity. Throughout this account, we will move between the intimate and the grand, between the private calculations of a merchant family and the thundering events of history. We will sit in the offices where major decisions were made. We will hear echoes of conversations at dinner tables. We will feel the weight of decisions that seemed technical but carried moral consequences. We will understand how a single family's commitment to a particular vision of how money should work rippled outward to touch millions of lives they would never meet. This is a story best heard slowly, best absorbed as you drift towards sleep, allowing the connections to form quietly in your mind. Because the Warburgs teach us something essential about how the world actually works, something that is obscured when we read only headlines or simplified explanations. They teach us that history is not made by single great men in moments of visible triumph, but by networks of people working across borders, across decades, with patience and careful intelligence. They teach us that exile and loss can coexist with legacy and influence. They teach us that banking, at its best, is not about accumulation for its own sake, but about the difficult art of moving resources to where they can do the most good. So as you settle into the rhythm of this narrative, allow yourself to wonder about what it might have felt like to be part of such a family, bound by duty, by affection, by shared conviction in an uncertain age. What would it have meant to choose between national loyalty and family loyalty? What would it have cost to flee everything you had built? And what does it tell us about resilience and adaptation that a family that lost so much was able to preserve what mattered most, the knowledge they carried in their minds, the relationships they maintained across distance, and the belief that their work, even stripped of its institutional home, still held meaning? The Warburg name itself arrived in history not in Hamburg, but much further south, in the Italian city of Bologna. sometime in the late medieval period. How names travel across centuries is itself a quiet mystery. We know them first as traders, merchants moving through the commercial corridors of northern Italy, when Venice and the trading republics were at their height. The name Warburg, or Warburg, as it was sometimes written in those early documents, appears in records from the 13th and 14th centuries, when the Renaissance was still being born, when fortunes were made not in steel or steam, but in silk and spices, and the careful extension of credit to other traders who lacked the capital to buy their own goods. These were not yet bankers in the grand sense. They were something earlier, something more humble, and perhaps more necessary. They were money changers first. They understood weights and measures of different coins, the subtle fluctuations in value between the Venetian ducat and the Florentine florin. They understood what every tradesman understood, that when you move goods across long distances, you need trustworthy people at the other end of the journey. Someone to hold your money, someone who will not vanish with it, someone whose name and reputation matter. The Italian city-states understood this deeply. Banking, as it would eventually be known, grew out of this simple need. The Medici family in Florence would make their fortune partly on this principle, the idea that trust could be accumulated, stored, made productive. But long before the Medici rose to their dominance, there were families like the Warburgs, learning the language of credit and capital in the bustling markets of Bologna and Venice. By the 15th century, the trail of the Warburgs leads northward. The family, like many merchant families of means and ambition, began to follow the great trade routes that connected Italy to the emerging power centers of northern Europe. These routes ran through the Alps, through the German territories, toward the Rhine and the North Sea. Hamburg, that great port city on the Elbe River, was becoming a magnet for traders and merchants of all kinds. It was growing, it was strategic, and it was, in the gentlest way possible, hungry for capital and expertise. Sometime in the 15th or early 16th century, the exact date remains pleasantly uncertain, one of those historical details that historians gently disagree upon. The Warburgs established themselves in Hamburg. Perhaps there was a specific moment, a decision made in a counting house, a letter sent north, a merchant arriving by boat. More likely, the movement was gradual, the way such things often are. A family member sent ahead to scout, another following a few years later. Connections established with local merchants. A small office opened. Then gradually, year by year, the deep roots began to grow. Hamburg in this period was a city of extraordinary commercial vitality. It was a member of the Hanseatic League, that federation of merchant cities that dominated trade across the northern seas and rivers. It was connected to London and Novgorod, to Bruges and Bergen. Ships arrived and departed constantly. Goods flowed in and out. Fortunes were made and lost. In such a place, a family with experience in credit and exchange, with contacts stretching southward to Italy and the Mediterranean, would have found abundant opportunity. The Warburgs, once settled in Hamburg, began to do what they had done before, but in a new context and at a larger scale. They became merchants first, trading in goods, but they also became something more useful, dealers in credit. When a Hamburg merchant wanted to ship goods to London and needed capital to purchase them in the first place, the Warburgs could help. They could advance the money. They could arrange for the goods to be paid for in London, converting the money into the right currency at the right rate. They took a percentage for this service. They bore the risk that the merchant might fail to pay them back. But slowly, over decades, this work accumulated into something more substantial. By the 17th century, the Warburgs were well established in Hamburg's merchant elite. They were not yet the banking family that would rise to prominence in the 19th century, but they had become something significant, a family whose name meant reliability in financial matters, whose judgment in matters of credit was trusted, whose access to capital, and whose understanding of distant markets gave them influence among other merchants and traders in the city. There is something worth noticing in this slow accumulation. It was not dramatic. There were no headlines. There was no moment of sudden transformation. Instead, there was the quiet work of generation after generation of Warburgs, learning their trade, building relationships, earning trust one transaction at a time. They understood something fundamental, that in matters of money, trust is not something you possess. It is something you build, carefully, brick by brick, over decades and across generations. The city of Hamburg itself was changing during these same centuries. It grew more prosperous, more connected to the wider world. It became one of the great ports of Northern Europe, a place where merchants from many nations gathered, where goods from the Americas began to arrive, where capital flowed across borders with increasing ease. The Warburgs grew with their city. They expanded their network of contacts. They sent family members to other cities, to Amsterdam, to London, to other trading centers. They learned new languages. They adapted to new products, new markets, new forms of financial innovation. By the time we reach the 18th century, the Warburgs were among Hamburg's most respected merchant families. They had survived wars and plagues and the economic disruptions that periodically swept through Europe. They had learned the art of hedging their bets, of maintaining relationships across religious and political divides, of being useful to whoever held power in their city. These skills, the ability to move with changing times while holding fast to core principles of honesty and prudence, would serve them well in the turbulent centuries to come. And it was in this context, in this city, in this merchant family with its long heritage of financial skill and accumulated trust, that something would be born that would eventually reshape not just Hamburg, but the financial world itself. But that story is still centuries in the making. To walk through the Altstadt of Hamburg in those middle decades of the 19th century was to move through a world that operated according to rhythms older than memory itself. The Jewish merchant community there, never vast in numbers, perhaps a few hundred families at its height, had woven itself so thoroughly into the fabric of the city's commerce that their presence had become almost as invisible as the tides that moved goods along the Elbe. And yet, of course, they remained perpetually visible in the ways that mattered most, in the eyes of those who watched, in the ledgers that recorded their transactions, in the subtle negotiations that preceded a handshake. It was into this particular texture of life that the Warburgs had gradually, almost imperceptibly, become rooted, not through any grand gesture of arrival, but through the accumulation of small dignities, a loan honored, a shipment insured, a promise kept when circumstances conspired to break it. This was the currency that mattered most in a world where formal legal recourse was often slow and uncertain, where a man's word and his family name had to substitute for the written contracts that others took for granted. The founding of the Warburg Bank, those initials standing for Marcus and Moritz, patriarch and son, came in 1798, though perhaps that word founding carries too sharp an implication of intention and ceremony. It would be more accurate to say that what had begun as one family's money lending gradually took on the character of a formal banking establishment, as if the Warburgs and their clients had simply one day looked up and noticed that the informal arrangements of the past had solidified into something more permanent. Marcus Warburg, the father, had worked in finance for much of his adult life. His son Moritz proved to have an intuitive grasp of the patterns of trade that moved through Northern Europe, the rhythms by which grain left the Baltic territories, by which English manufactured goods sought continental markets, by which investment capital flowed toward the enterprises that promised future returns. What distinguished the Warburg operation, even in its earliest years, was not innovation. Banking itself was ancient beyond reckoning, but rather a particular kind of scrupulousness. They maintained their accounts with a precision that became almost legendary. They refused commissions on certain transactions if they believed the client was being overextended. They studied not merely the immediate profitability of a venture, but its likelihood of surviving the inevitable contractions of trade and credit that visited every generation. This accumulated to something that resembled not just reputation, but a form of trust that had become almost tangible. A merchant who had done business with the Warburgs once was more likely to return. A family that had borrowed from them and repaid was more likely to recommend them to others. The physical space in which this business unfolded was itself modest, a modest counting house, a room lined with those ledgers that recorded every transaction, every promise, every covenant between debtor and creditor. The partners themselves moved through this space with a kind of quiet attention that spoke more eloquently than any advertisement could have done. They were present, they were engaged. When a client arrived with a question, he was not turned away with a formula, but invited to sit, to explain himself, to have his circumstances understood. The Hamburg Jewish merchant class, of which the Warburgs were now increasingly prominent members, possessed a particular advantage in this era, though it was an advantage hard-won and perpetually precarious. They existed in a kind of permanent diaspora, scattered across the trading routes of Europe, connected by family ties and religious observation, and the necessity of moving capital across borders, where official channels were often closed to them. A Warburg in Hamburg could make arrangements with a Warburg in London, or, eventually, with cousins in the banking houses of Frankfurt and beyond. The Christian banking houses possessed wealth and official sanction, but the Jewish banking families possessed something equally valuable, a network that transcended the merely local, a way of moving information and capital through informal channels that often proved faster and more reliable than official mechanisms. This network, however, was built and maintained only through an almost monastic devotion to reliability. A promise broken by one member of the community rippled outward, threatening the standing of all. Conversely, a reputation for absolute integrity, for returning the borrowed copper coin, for making good on a loss, for never allowing the pressure of immediate need to tempt one into a dishonest calculation. Such a reputation compounded over time, like interest itself. The Warburgs seemed to understand this intuitively. Or perhaps they were simply fortunate in the temperaments they inherited, generation to generation, a capacity for discipline, for delayed gratification, for seeing oneself not as an individual actor, but as a link in a chain extending both backward and forward through time. By the 1830s and 1840s, as Hamburg gradually transformed from a city of sale and manual labor into something approaching modernity, the Warburg Bank had become one of the city's most respected financial institutions. This was not measured in the flashiness of transactions or the boldness of speculation. It was measured in the quiet frequency with which wealthy merchants sought the Warburgs' counsel. It was measured in the number of transactions they mediated. It was measured in the depth of capital they could mobilize when significant ventures required backing. And yet there was something almost paradoxical in this rise. The Warburgs' power derived in significant measure from their restraint. They did not expand recklessly. They did not pursue every profitable opportunity that presented itself. Instead, they seemed guided by an almost conservative instinct, a preference for the gradual accumulation of capital over the dramatic seizure of opportunity. Where other banking houses might have overextended themselves during boom periods, the Warburgs maintained reserves. Where others might have dissolved in the face of sudden reversal, the Warburgs possessed both the capital and the temperament to weather uncertainty. This, then, was the institution and the family culture from which the subsequent generations of Warburgs would emerge. Not a banking house built on the drama of speculation or the gamble of an innovator's vision, but one constructed brick by brick through the patient demonstration that they could be trusted, that they would not disappear when times grew difficult, that their word was as good as their bond, that they understood that banking, stripped of all its mystique and mathematics, was fundamentally about connecting those who possessed capital with those who could make productive use of it, and that the truest wealth lay not in the accumulation of capital itself, but in being the person to whom others came when they needed to understand how to move that capital through an uncertain world. The Altstadt around them continued to evolve. Ships grew larger, trade grew more complex, governments proved more demanding in their tax collections and more intrusive in their regulations. But the counting house remained. The ledgers continued to be kept with the same meticulous care, and the Warburgs, solidifying their position not through any singular act of ambition, but through hundreds of small decisions guided by principle and patience, had become one of those families upon whom the economic life of an entire city had come quietly to depend. And so, as the 18th century folded into the 19th, the Warburg family's quiet accumulation of capital and reputation began to take a different shape. The impulse to lend, to facilitate trade, to sit at the crossroads of commerce where trust became currency. These instincts that had defined the family's earlier decades now began to crystallize into something more formal, more architecturally ambitious. A proper banking house was taking root, one that would eventually reach across all the great trading cities of Europe, from Amsterdam to London to the financial capitals of Italy and France. The figure of Moritz Warburg stands at the threshold of this transformation. Born in the closing years of the 1700s, Moritz inherited not merely capital, but also a kind of financial intuition that ran through the family like bloodline itself. What distinguished him, however, was a certain boldness of vision, a willingness to think beyond the immediate transaction, the small loan that moved goods from one port to another. Moritz understood something that many of his contemporaries did not. He grasped that banking in the modern age, and the 19th century was indeed modern in ways that demanded new thinking. Banking would require an entirely new relationship with the state, with governments themselves. During his years as the principal banker of the Warburg family enterprise, Moritz began to broker something more substantial than trade credit. He began to arrange loans between Hamburg itself and the various German principalities. He facilitated transactions that helped governments manage their debts and their ambitions. The scale of these operations, the sheer magnitude of the sums moving through his accounting books, began to set the Hamburg Warburg firm apart from other Jewish merchants, other banking families. The distinction between a merchant who lended money and a banker who shaped the financial fate of cities, that line was becoming clearer, more intentional. What is perhaps most remarkable, and what would echo through generations of Warburgs to come, was Moritz's instinct to build what might be called a federated structure. Rather than keeping all operations within Hamburg's narrow confines, he began to establish partnerships, to cultivate relationships with banks in other cities. These were not quite branches in the modern sense, but something more delicate, understandings between families, arrangements cemented by letters of credit and mutual trust. A Warburg in Hamburg could therefore speak with authority not only on German financial matters, but increasingly on the financial currents flowing through all of Northern Europe. The early decades of the 1800s brought particular opportunity. The Napoleonic Wars, for all their terrible human cost, had scrambled and reorganized the financial architecture of Europe. New nations were emerging, new systems of government and commerce were being invented almost daily. In this ferment of change, a banking family with the right kind of agility, with connections both Jewish and Gentile, with a reputation for discretion and sound judgment, such a family could position itself at the very center of European capital flows. The Warburgs, across these years, were doing precisely that. It was during the tenure of Moritz and his immediate successors that something quite subtle but profoundly important occurred. The family began to acquire not only wealth, but what might be called social permission. Hamburg's merchant elite, The Christian trading families who had long dominated the city's commerce began to accept Warburg capital into their councils. They began to ask for Warburg advice on matters of municipal finance. A Jewish banking family, still bound by many of the legal and social restrictions that characterized even the relatively progressive city of Hamburg, was nonetheless beginning to operate almost as if those restrictions did not exist, not through law, but through the sheer undeniability of their competence and their utility. Picture, if you will, the Hamburg of the 1830s and 40s. The city was experiencing the first real tremors of industrialization. The old medieval streets, the gabled houses that rose near the canals, the wooden wharfs where ships had been loaded and unloaded for centuries. All of this was beginning to coexist with something new: factories, steam engines, a need for capital that far exceeded what the traditional merchant class could provide. The Warburgs understood this shift, perhaps better than anyone. They recognized that banking in an industrial age was not merely a matter of individual transactions, of facilitating one merchant's trade with another, but rather a question of capital accumulation and deployment on a scale that required new kinds of institutions, new kinds of thinking. By the second quarter of the 19th century, Warburg Co. had established itself as not merely one banking house among many in Hamburg, but as a kind of institution that the city's commercial and municipal leaders consulted on matters of genuine consequence. The bank held deposits from merchant families, certainly, but it also managed funds for the Hamburg city government itself. It participated in the financing of infrastructure projects. It arranged for the movement of capital across the seas to Amsterdam, to London, and in particular to America, where a growing number of German merchants were looking to establish trade networks. Siegmund Warburg, Moritz's successor in the family leadership, appears to have been a figure of almost preternatural calm and judgment. The historical record, though not voluminous, suggests a man who had absorbed all of his father's gifts for finance, but who seemed to possess in addition some quality of presence, of the kind of authority that does not need to announce itself. Those who met him in the corridors of Hamburg's banking district apparently found themselves inclined to listen when Siegmund Warburg spoke. Perhaps it was his bearing, perhaps it was simply the cumulative weight of the family's financial success, the knowledge that the Warburgs had money, substantial, growing, meticulously managed money, and that they had demonstrated over decades that they could deploy it wisely. Under Siegmund's leadership, the bank's reputation solidified. It began to be spoken of, not in the local dialect of Hamburg commerce, but in the language of European finance. Colleagues in London, in Frankfurt, in Paris, even in Naples and Vienna, began to know the name Warburg, and to know what it meant: discretion, competence, a family banking house that understood the grand architectures of international capital, not merely the small transactions of local trade. Is it possible that Siegmund Warburg, as he moved through the middle decades of the century, could have foreseen that his family's banking enterprise would one day be asked to help reshape the monetary foundations of the United States itself? Almost certainly not. And yet the very qualities he was cultivating, the reputation for sound judgment, the networks of trust that stretched across a continent, the family's willingness to think beyond their own immediate profit toward the broader stability of the financial system, these were the very seeds from which that future would grow. The civic role that the family acquired during these decades was, in its own way, quite extraordinary. Despite the persistent social exclusions and legal disabilities that still attended Jewish life in Hamburg, the Warburgs became advisors and even donors to various civic projects. They funded educational institutions. They participated in discussions about the city's future. To walk through Hamburg in the later 19th century and see the name Warburg attached to a school, or to hear it invoked in discussions at the Chamber of Commerce, was to witness something remarkable: the slow, persistent transformation of a Jewish merchant family into what might almost be called a civic institution themselves. And yet there remains something both touching and peculiar about this rise. The Warburgs were achieving a kind of prominence that, in many parts of Europe, and certainly in many parts of the world, would have been quite simply impossible for a Jewish family to attain. They had, through patience and capability, and a certain shrewd navigation of the particular opportunities that Hamburg offered, essentially transcended the most restrictive dimensions of their social position. And yet the transcendence was never complete. There remained always a kind of provisional quality to their acceptance, a sense that they inhabited a place and a role that was granted to them, rather than entirely their own by right. This tension between their extraordinary prominence in financial circles and the persistent fragility of that position would shape the family's character in ways that would not become fully visible until much later, when the gathering shadows of the 20th century fell across the continent they had worked so patiently to navigate. The story of the Warburgs is, in many ways, inseparable from a much larger tapestry, one that wove itself across the continent throughout the 19th century, a pattern of Jewish banking families who rose from merchant quarters and ghettos to become architects of European finance. To understand what made the Warburgs distinct, and what they shared with others of their kind, it helps to rest for a moment in this broader landscape, to see the shape of the whole before we return to the particular brightness of their own ascent. Throughout the 1800s, when industry was reshaping the map of Europe, and capital was beginning to flow in unprecedented currents, a small number of Jewish banking houses emerged as essential intermediaries. Some historians have called this the era of the great financial dynasties, though not all of them were equally great, and few reached their prominence without extraordinary circumstance and calculated patience. The Rothschilds, perhaps the most celebrated of all, had begun in Frankfurt with a single counting house in the 1760s and had grown, by mid-century, into a network spanning London, Paris, Vienna, and Naples. 5 brothers, each commanding his own fortress of capital and credit. There were the Lazards in Paris, the Mendelssohns in Berlin, the Lehrs in Vienna, the Lehmanns in Hamburg, though the Lehmanns were, of course, rivals as much as neighbors to the Warburgs. What strikes one about these families, when viewed from a distance, is how similar their trajectories often were, despite the different textures of the cities in which they worked. They emerged during periods when traditional Christian banking had become bound by religious law and old habit, when the Church's prohibition on interest-taking had loosened enough to allow others a foothold, when expanding trade routes demanded new kinds of credit that the medieval banking world could not provide. Jewish merchants and moneylenders, long excluded from many professions, had developed over centuries a sophisticated understanding of exchange, risk, and trust across borders. They knew languages. They had family networks that stretched from Algiers to Amsterdam. They understood that a ledger in one city could speak to a ledger in another. By the 19th century, as industrialization demanded vast sums for railways and canals and factory machinery, these families found themselves suddenly indispensable. A government needing to borrow millions for war or infrastructure would turn to the Rothschilds. A railway company seeking to lay track from Vienna to Prague would go to the Mendelssohns. The Warburg Bank, though smaller than these titans, occupied a similar niche, a channel through which capital could flow, a guarantor of sound judgment and reliable stewardship. What enabled this rise, though, was something more than mere circumstance. Each family had internalized, over generations, a particular code of conduct that merchants had refined in the medieval Mediterranean. The idea that reputation was capital itself. A promise made by a Warburg brother in Hamburg was as good as a Warburg brother's promise in London or New York, because the family stood behind every word. This was not sentimental trust, it was trust built on the bedrock of accountability and honor. If one brother defaulted, all suffered. If one prospered, the system made room for the others to prosper as well. The rise of these dynasties, one should note, was not without its undertone of unease in European society. There was always an element of envy, and, one must speak plainly, an element of something darker still. As Jewish bankers accumulated wealth and influence, they became visible targets for a particular kind of resentment that had coiled through European culture for centuries. The stereotype of the Jewish moneylender, once confined to marginal corners of the economy, now seemed to have a basis in fact, at least to those inclined to see it that way. Rothschild conspiracy theories would flourish in the 19th and 20th centuries, wild fantasies that these families controlled governments and shaped wars for profit. None of it was true, yet all of it was believed by people in positions of considerable power. This is a thread we will return to, because it runs through the Warburg story as well, with consequences that became terrible. Still, in the decades before the First World War, Jewish banking families occupied a peculiar kind of respectability. They were wealthy, educated, and, importantly, useful. Many had begun to assimilate into the broader life of their adopted cities. The Warburgs, for instance, were civic figures in Hamburg. They served on cultural boards, they commissioned art, they educated their children not only in business, but in philosophy, languages, and the refinements of European culture. One could imagine, in those long, gaslit evenings of the 1890s, that money and merit might overcome the old religious boundaries, that a banker's skill with capital might matter more than the synagogue his family attended. This optimism would later seem almost heartbreaking in its naivete, but for a generation it felt real. The Warburgs and families like them had achieved something remarkable, not merely wealth, but a kind of integration into the intellectual and financial life of their nations. They had become, in a sense, indispensable not just because they controlled money, but because they understood money in a way that the old European aristocracy could not. The industrial age required a new kind of mind, one that could think in networks and flows and futures. The Jewish banking families possessed this mind, and the Warburgs in particular were about to demonstrate just how far such a mind could reach when it touched American shores. The family's peculiar position, respected in Hamburg, connected by marriage and business to London and Paris and Vienna, yet always conscious of being, in some fundamental way, outside the inner circles of Christian Europe, would shape how they approached the challenge they were about to inherit. It was a position of both advantage and vulnerability, and understanding this broader context of their peers helps illuminate why the Warburgs would eventually come to play such an outsized role in shaping American finance. But before we turn to that great drama, we must turn our attention to the five brothers themselves, each of whom inherited not merely money, but a particular temperament and expectation about what service to the bank might require. The Hamburg of the 1870s and 80s was a city where boys born into merchant families understood, long before their voices deepened, that their futures had already been written into the ledgers. And so it was with the five Warburg brothers, Abby, Max, Paul, Fritz, and the youngest Warburg, each of whom would navigate that expectation in their own singular way, some with ease, and some with the kind of quiet resistance that only a gifted mind can sustain. Begin with Max, the eldest surviving son, who seemed to have arrived in the world with an almost preternatural grasp of the banking temperament. Those who knew him in his youth spoke of a steadiness that bordered on the monumental, a kind of ballast in the human form. He was meticulous, yes, but never cold. His ledgers were precise, not out of obsession, but out of respect for the truth that numbers contain. From childhood, Max moved through the banking house as though he had been born into its rhythms, and by the time he reached his 20s, he had already begun to assume the role that would define him, the guardian of continuity, the man who would hold the family bank steady through fortune and later through catastrophe. In contrast, consider Paul, the second son, whose mind ran along different channels entirely. If Max was the steady current, Paul was the person who stood on the bank and asked why the river ran in that direction at all. He was intellectually restless, possessed of a kind of nervousness that manifested not in anxiety, but in an almost scientific hunger to understand systems, financial systems, primarily, but also the deeper logic of trade and credit, and the invisible threads that bound markets across oceans. Even as a young man, Paul gave the impression of someone always listening, always absorbing, as though the world were a problem set that he was slowly beginning to decipher. The family expected both Max and Paul to lead. That was certain. But what of the others? Abby, the eldest son, and here one must pause and acknowledge the tragedy that shapes this part of the story, had been considered the natural heir until illness took him in early manhood. What little history records of Abby suggests a person of considerable intellectual promise, though the specifics of his temperament fade into the mist of time. His early death meant that the weight of expectation fell more heavily upon Max's shoulders, and perhaps this is why we know Max's story so much more fully than Abby's. The living are always more vivid than the departed. Then there was Fritz, quieter than Paul, steadier than Abby, a person who seemed content to find his place within the existing structure of the bank, rather than to challenge or reshape it. Fritz carried out his duties with competence and without complaint, the kind of son who would have pleased any father. And yet history has rendered him nearly invisible, a figure glimpsed only occasionally in the correspondence and memoirs of more forceful brothers. One might speculate, though one must do so gently for the record is thin, that Fritz embodied a kind of contented acceptance, the choice not to remake the world but to understand it as it was. The youngest, also named Warburg, occupied a peculiar position, born into a family already of considerable standing, arriving into a household where the expectations were already fully formed, already made beautiful and terrible by their clarity. Less is known of him than of his brothers, and this absence itself tells a story. The youngest of a large merchant family in a rigidly structured society often finds that the path has been so thoroughly worn by those who came before that there is little room for innovation, little space to make one's own mark. What bound these brothers together, despite their temperamental differences, was something more subtle than mere blood relation. It was a kind of shared understanding, absorbed almost by osmosis, that they belonged to an enterprise larger than themselves. The Warburg Bank was not merely a place of business. It was a covenant, a trust passed forward through generations. To be a Warburg was to carry a responsibility that began, truly, at birth. Consider the education these boys received, not for them the carefree wanderings of childhood. Instead, from adolescence onward, they were apprenticed into the business. This was not unusual among merchant families. The model had prevailed for centuries, but it was also, one might say, a kind of loving imprisonment. They learned languages, not as academic exercises, but as tools for practical commerce. They learned mathematics not in abstract terms, but as the grammar of profit and loss. They travelled to London, to Paris, to Amsterdam, not as tourists, but as representatives of the family house, carrying letters of credit and carefully cultivated relationships. The family expectation was clear and unambiguous. The bank came first. Marriage was acceptable only insofar as it served, or at least did not damage, the family's financial interests. Divergence into other professions, into art, into scholarship, into any field that did not directly serve the house, was understood as a kind of betrayal, or at minimum, a waste of privilege. This was not harshness necessarily, it was rather the natural order of things as the 19th century merchant family understood it, the logic that had sustained their rise and that they could not imagine being otherwise. And yet, even within this rigid framework, there was room for variation, for personality, for the small rebellions that make a human life individual rather than purely functional. Max accepted his role with what seems to have been genuine contentment, perhaps even with something approaching relief. Here was a man for whom the structure of the bank provided not constraint but clarity, the kind of clear purpose that some temperaments require in order to flourish. Paul, by contrast, accepted his inheritance, but with questions attached to it. He would serve the bank, yes, but not without first understanding precisely how the mechanisms of modern finance operated, not without studying the great banking houses of Europe, not without attempting to grasp the underlying principles that made credit and capital flow as they did. His acceptance came wrapped in curiosity, which is perhaps to say that it was not quite acceptance at all, but rather a kind of strategic patience. The father of these boys, Sigmund Warburg, oversaw this formation with the distant but firm hand of the German merchant patriarch. He had built the bank into something substantial, something respected, and now his primary role was to ensure that what he had constructed would endure beyond his own lifetime. His sons were not merely his children, they were the vessels into which he poured everything he had learned about finance, about Hamburg, about the cultivation of trust and the accumulation of capital. What emerges from the fragmentary records is a picture of a family bound together by something more complex than simple duty. There was affection here, certainly. There was also expectation. There was the unspoken understanding that to be born a Warburg was to inherit not merely wealth, though there was that, but a kind of moral obligation to stewardship. The bank was not something to be exploited for personal gain. It was something to be served, to be protected, to be passed along to the next generation in as good condition as one had inherited it. And so, as these five brothers came of age in the closing decades of the 19th century, they carried within them this dual inheritance, the practical knowledge of commerce and finance, passed down through years of apprenticeship and example, and the deeper, less articulable sense that their lives were woven into something larger than themselves. Some would embrace this fully, others would spend much of their lives attempting to expand its boundaries, but none, in the end, would be free of it entirely. The youngest of the five Warburg brothers would come to reshape not just his own family's fortune, but the financial architecture of an entire nation. His name was Paul, and even as a boy moving through the corridors of the family counting house in Hamburg, there was something restless in him, a mind that seemed to reach outward, toward horizons his older brothers were content to inherit without question. Paul Warburg was born in 1868, into a household already accustomed to the rhythms of banking and commerce. Yet where his older brother Max had settled into the steady certainties of managing the family firm, Paul possessed a different temperament altogether. He was curious in a way that made the elder merchant slightly uneasy, prone to asking not just how transactions were completed, but why they were structured the way they were. What assumptions lay beneath the methods his grandfather had employed? What might be possible if those assumptions were gently questioned? His father, Sigmund Warburg the Elder, recognized something in the boy and decided early that Paul's education would not be confined to Hamburg's quiet banking quarter. At an age when most young men of his station were already learning the mechanics of the family trade at the partner's desk, Paul was sent abroad to complete what was then considered the most thorough apprenticeship available to a young banker, a kind of grand tour, but with ledgers instead of guidebooks. He travelled first to London, where the great banking houses along Lombard Street still operated with the customs and confidence of merchants who had financed empires. There he watched how bills of exchange moved like blood through the veins of international trade, how credit flowed from the City of London to the far corners of the world, and how the Bank of England moved almost invisibly behind it all, a steady hand on the pulse of British finance. From London, his path led him to Paris, where the great banking dynasties, the Rothschilds chief among them, had built fortunes on an intricate understanding of currency movements and political risk. In Paris, Paul would have studied how French banks navigated the complex terrain between government favor and market independence, how they managed relationships with politically fragmented Italy and a unified but restless Germany. Each city added layers to his understanding. Each apprenticeship refined his sense of how money actually moved through the world, when you removed the formal structures and looked at the underlying currents of supply and need and fear and opportunity. But it was his time in the United States that would prove most formative, most transformative. By 1889, when Paul first crossed the Atlantic, America was not yet the financial superpower it would soon become. It was a nation of extraordinary productive capacity. Yes, the railroads, the factories, the relentless westward expansion, but its financial system was fragmented, almost chaotic by European standards. There was no central bank. There was no coordinating mechanism, no quiet hand on the national pulse. Instead, there were thousands of independent banks, many of them small, undercapitalized, vulnerable to waves of panic that could sweep across the country with devastating speed. Paul was astonished by this, if one reads between the lines of his later writings and testimony. Here was a nation with more natural resources and productive capacity than all of Europe combined, yet its banking system operated as though it were still the 19th century in every practical sense. There was no agreed-upon discount rate, no mechanism for moving reserves from regions of surplus to regions of scarcity, no institution that could calm a fearful population when confidence in the banks began to crack. He found work at the banking house of Kuhn, Loeb & Co., a connection made possible through his older brother Felix, who had married into the Loeb family and established himself in New York, and from this position he had a front-row seat to the vulnerabilities of American finance. What haunted Paul, one senses, was the inefficiency of it all. A crisis in one region could trigger panics in others simply because there was no mechanism to distribute confidence or capital smoothly across the system. A failed harvest in the agricultural West could create a liquidity squeeze that would reverberate through the banks of the eastern cities. A sudden loss of foreign confidence in American securities could drain gold reserves and trigger a scramble for cash that no individual bank could adequately manage. The system seemed to work well enough in ordinary times. Prosperity was real, growth was genuine, but it was a prosperity built on a foundation that could crack without warning. During his years in New York and his regular returns to Hamburg, Paul began to observe more closely how other nations had attempted to solve these problems. The Bank of England, for all its faults, provided something like a coordinating function. The Reichsbank in Germany, created just after unification, had been designed from the ground up, with mechanisms for stability and adjustment. Even the smaller nations of Europe understood that some central coordination was necessary to prevent the kind of recurring panics that had plagued earlier eras. Why, Paul began to ask with increasing urgency, did the wealthiest and most productive nation on earth lack even the basic architecture that smaller European powers had already constructed? This question consumed him. He studied the European systems with the patience of a scholar, learning not just their mechanical features but their history, why they had been designed this way, what problems they had been meant to solve, what new problems had emerged. He corresponded with central bankers across Europe, attended banking conferences, read voraciously in German, French, and English about monetary theory and financial history. His mind was preparing itself, though he could not have known it, for the great work that would occupy the second half of his life. What made Paul different from other wealthy bankers of his era was a kind of intellectual humility combined with absolute conviction. He was not arrogant about his ideas, yet he seemed certain, in a quiet, almost patient way, that he understood something essential that others had missed. He could see the fragility in the American system, not because he was cynical about it, but because he had seen the alternatives, had watched how other nations had learned to manage the recurring crises that seemed to plague all market economies. There was something sad in his manner when he spoke of American banking, as though he were watching a person he cared for stumble toward an injury he could foresee but could not yet prevent. While his younger brothers pursued ambitions that would carry them across oceans and into the machinery of international finance, Max Warburg remained in Hamburg, tending to the bank as a gardener tends an ancient orchard, knowing that steady cultivation matters more than dramatic transformation. Born in 1866, Max inherited not just a name but an expectation that had calcified over generations, that a Warburg belongs to the Warburg Bank, that the institution is less a business than a kind of vocation, a calling that demands not brilliance alone but fidelity, judgment, and an almost monastic patience with the slow rhythms of capital accumulation. What made Max's tenure as head of Warburg Co. distinctive was not flashiness, but a particular kind of gravitas, a reputation for measured counsel that grew quieter the more weight it carried. By the 1890s, as his older brother Siegmund aged, Max moved naturally into the role of principal voice, the banker whom other bankers consulted not for clever schemes, but for a steady appraisal of what could be sustained. In the world of merchant banking, where relationships often outlasted markets, where a handshake still held legal weight, where reputation was the only currency that mattered more than gold, Max became known as someone who would not bend. He would not engage in speculation that might inflate the bank's fortunes while hollowing its character. He would not pursue clients whose motives seemed shadowy or whose collateral lay in rumor rather than tangible asset. This temperament, which might have seemed almost quaint in an era of rising industrial titans, proved instead to be a kind of armor. While less cautious banks crashed and burned during the volatile decades of the 1880s and 1890s, while stock bubbles inflated and burst with the regularity of a failing heart, Warburg endured. Its capital base grew modestly. Its network of correspondents across Europe thickened and deepened, and perhaps more importantly, the bank accumulated something intangible but invaluable: the trust of other institutions, the confidence of wealthy families who knew that Max Warburg would not gamble with their fortunes. By the early 20th century, Max had become something of a fixture in Hamburg's financial establishment, a figure whose opinion on matters of credit and monetary stability began to be sought not only by private merchants, but by civic authorities and even government officials. The Hamburg Chamber of Commerce consulted him. The city's municipal administrators valued his counsel on borrowing and debt management. And as the German economy continued its rapid industrialization, as competition with British manufacturing intensified, as questions about currency stability and international trade grew more urgent, Max Warburg found himself drawn into circles where finance and politics intersected in ways that were subtle but consequential. It would be a mistake to imagine Max as a political operative or a grand strategist pulling hidden strings. His nature was far too reserved for such theatricality, but rather he was increasingly present in those quiet rooms where questions were posed. How should Germany manage its growing international debts? What policies might stabilize the relationship between Hamburg's merchant class and the industrial powerhouses of the Ruhr? How could a city built on maritime trade position itself as Germany's economy became more complex and interconnected? In such conversations, Max's voice carried weight, not because he sought authority, but because he had earned it through decades of demonstrating that his judgments were grounded in careful observation rather than wishful thinking. One might wonder whether Max felt a certain tension between his role as a private banker, responsible to the Warburg family's interests, and those of the bank's clients, and whatever advisory responsibilities he was gradually assuming. The historical record suggests that he navigated this with a kind of moral fastidiousness. He was willing to offer his analysis, his perspective, his hard-won knowledge of how credit moved through European systems, but he remained fiercely protective of the bank's independence and skeptical of anything that smelled of political patronage or favoritism. This stance, held with the kind of quiet firmness that made disagreement difficult, may have cost him certain opportunities. It also likely preserved the bank's reputation at moments when proximity to failed government policies might have tainted lesser institutions. What's striking, looking back across the decades, is how Max Warburg's emergence as an informal advisor seems almost inevitable given the times. Germany in this period was anxious about its place in the world economic system. British banking still dominated international finance. France maintained close ties through its banking families to centers of capital throughout Europe. The United States, still something of a financial adolescent, was growing muscular and unpredictable. In this context, a banker like Max, educated, multilingual, thoroughly versed in the mechanics of European finance, yet distinctly German in his loyalty and perspective, became a kind of interpreter, someone who could help German industrialists and political thinkers understand the larger currents moving through the world economy. His brother Paul, across in New York, was simultaneously inhabiting similar spaces in American banking and financial circles, and though we will come to know more of Paul's more dramatic role in shaping the Federal Reserve, it is worth noting that Max, too, was preoccupied with fundamental questions about how monetary systems should function. The difference was temperament and circumstance. Paul was more idealistic, more willing to take intellectual risks, more comfortable with radical redesign of existing institutions. Max was a conservator, a man who believed that sound banking practices developed over centuries should be preserved, refined, and protected from the enthusiasms of reformers who did not fully understand the delicate machinery they might disrupt. Within Hamburg's Jewish merchant community, Max's position was also distinctive. As the bank prospered and remained solvent through economic cycles that destroyed lesser houses, as Max himself married and established a household that reflected both commercial success and refined cultural sensibility, he became something of a symbol of the integration that was theoretically possible, a man whose religious identity and his role in Germany's financial apparatus seemed, at least on the surface, not incompatible but mutually reinforcing. That this seeming reconciliation would later prove tragically illusory was not yet apparent in the early decades of the 20th century. For now, Max Warburg occupied a position that allowed him to believe that knowledge, competence, fidelity to sound principles, and the quiet accumulation of respect might be sufficient to secure a place in the world for himself and his family. The correspondence of the era, letters between Max and his brothers, communications with business associates, the occasional notation in newspapers about his participation in some economic symposium or his influence on some financial question, reveals a man of immense capability and equally immense restraint. He had the opportunity, many times over, to push the bank into more aggressive ventures, to leverage the family name and his own reputation into spectacular financial coups. That he chose instead the narrower path of steady, thoughtful leadership suggests something about his character that went deeper than mere caution. It suggests a kind of philosophical belief that institutions matter, that they endure only when they are treated as ends in themselves rather than as vehicles for individual ambition, and that the most important work is often the work that goes largely unnoticed, the unglamorous, steady cultivation of trustworthiness and sound judgment in a world that was beginning to grow dizzy with its own velocity. While the Hamburg Bank flourished under careful management and the brothers grew into their respective domains, the youngest of the 5 Warburg sons was quietly preparing a journey that would plant the family's roots on another continent entirely. Felix Warburg, born in 1871, possessed a gentler temperament than some of his siblings, less the warrior banker that Max embodied, more the sensitive aesthete with an eye for beauty and a genuine curiosity about how money could serve purposes beyond mere accumulation. His path, it seemed, had been shaped by something other than the deliberate family plotting that had guided his brothers. And yet it would prove among the most consequential. In the 1890s, as Hamburg's foglit quays hummed with the commerce of empires, Felix had begun spending time in the banking circles of Frankfurt, that other great Jewish financial center of the German lands. There, in the web of relationships that connected every significant banking family across Europe like thread on a loom, Felix encountered the American banking house of Kuhn, Loeb and Company. It was one of the few truly grand financial institutions across the Atlantic that had been founded and led by men of Jewish faith, a remarkable thing in an American landscape still wrestling with its own prejudices and exclusions. Kuhn, Loeb had become, over decades of shrewd dealing and impeccable reputation, perhaps the most powerful investment bank in New York. Its reach extended into railroads, industrial consolidations, and the financing of nations themselves. The founder, Joseph Kuhn, had retired by the time our story draws near, leaving the firm in the capable hands of Jakob Schiff, a man of towering intellect and ethical conviction who had emigrated from Frankfurt decades earlier. Schiff had taken what Kuhn had built and expanded it with a vision that extended far beyond the counting house. He was a philanthropist, a reformer, a man who believed that great wealth carried an obligation to the broader human community, and he had been watching European banking families with considerable interest, particularly those Jewish houses that combined tradition with forward thinking. The Warburgs, he knew, were precisely that mixture. The connection between the families arrived not through some coldly arranged financial negotiation, but through the warm channel of a young woman's heart. Felix Warburg had fallen in love, genuinely, deeply, with Frieda Schiff, the intelligent and cultivated daughter of Jakob Schiff himself. Perhaps it was chance that drew them together, or perhaps the intricate geography of the Jewish merchant and banking world made such meetings nearly inevitable. What matters is that their affection was sincere, and when marriage was proposed, it carried with it implications that extended far beyond the personal happiness of two individuals. Jakob Schiff was a man of principle, and he would not simply hand over his firm to any suitor, no matter how respectable the family. But Felix Warburg brought something invaluable to New York. He brought the accumulated expertise, the international connections, and the sterling reputation of one of Europe's finest banking institutions. More subtly, he brought Hamburg's way of understanding long-term relationship building and trust. And Schiff, aging gracefully into his later years, recognized in Felix a kindred spirit, someone who understood that banking was ultimately about stewardship, not merely profit. When Felix made his decision to move to America, it was framed as a partnership, though one imagines there were delicate conversations about what his role would entail. He would join Kuhn, Loeb and Company, not as a subordinate, but as an emerging figure in its leadership. His marriage to Frieda was more than a romantic union. It was the thread that wove the Warburg name directly into one of America's most influential financial institutions. And in weaving that thread, Felix had created something that would prove strategically essential for his own family's interests in the years to come. The journey from Hamburg to New York in those days was still an ordeal. Weeks at sea, the heaving Atlantic, the slow approach to America's shores. But for a young banker stepping into a position of genuine influence in the world's wealthiest nation, the voyage must have seemed less an inconvenience than a threshold. Felix arrived in the 1890s with his bride, and almost immediately began to make himself useful. He brought to New York banking circles an understanding of European methods, European relationships, and European sensibilities. He was fluent in German, French, and English. He understood the intricate choreography of international finance in ways that even talented American bankers, however sharp, could not always grasp. What happened in New York, as Felix settled into his work at Kuhn, Loeb, and as he and Frieda began to build a life in the city, was something that resembled the patient accumulation of influence that his ancestors had practiced in Hamburg. But it was influence of a different character, operating at a different scale. Hamburg was a known quantity, a medieval city where banking families had existed for centuries. New York, by contrast, was chaotic, explosive with growth, teeming with ambition and newcomers. The very things that made it feel unfamiliar to a Hamburger would also be the sources of its enormous power. And it was precisely at this moment in American history, when Felix was establishing himself at Kuhn, Loeb, and cementing the Warburg family's presence on the eastern seaboard, that the machinery of American finance was beginning to strain under the weight of its own improvisation. The country had no central bank. It had no coordinated way of managing monetary crises. It had rules made in the 1860s and 70s, cobbled together during Reconstruction and the era of manifest destiny, that were proving increasingly inadequate to the demands of a modern industrial economy. And within a few short years, that inadequacy would produce a panic so severe that it would reshape everything. It was sometime in the autumn of 1902 when Paul Warburg made a choice that would quietly reshape the financial architecture of a nation he had never called home. He had been invited to America by his brother-in-law Jacob Schiff, a partner in the house of Kuhn, Loeb Co., one of the most influential private banking firms on Wall Street, and the invitation carried with it an undertone of expectation that Paul understood without needing to hear it spoken aloud. Felix had already made the crossing some years before, marrying into the Loeb family and settling into the rhythms of New York finance. Now it was Paul's turn. The timing seemed almost scripted by the family's own hand, as if the Warburgs were deliberate architects of their own global reach, planting themselves in the financial capitals of the world like merchants of old had planted trading posts along distant coasts. Hamburg had been his world. He was a man shaped by the particular culture of that banking quarter, where the air itself seemed to smell of ledgers and salt spray, where handshakes carried weight equal to written contracts, where reputation was not merely an asset, but almost a religion. The Warburg Bank had grown under his influence and his father's before him into a respected house, known for its careful judgment and its reluctance to take unnecessary risks. Paul had apprenticed not only in his own bank, but had travelled to Paris, London, and other financial centres, absorbing the languages not just of commerce, but of the deeper machinery that moved capital across borders. He had spent time in Paris observing how the Banque de France operated, studying its mechanisms, its relationship to the government, the way it seemed to calm the entire financial system through a kind of assured presence. When he arrived in New York, stepping onto the docks or perhaps the train platform, Paul Warburg carried with him not just his belongings but a kind of trained eye, the eye of a man accustomed to observing how money systems worked. What he saw in America would trouble him almost from the beginning, though he would spend years in quiet study before he began to speak openly about his concerns. The American banking system, as it existed in the early years of the 20th century, was a cathedral of fragmentation. There was no central bank, had been no central bank for nearly 80 years, ever since Andrew Jackson had so decisively killed the second bank of the United States. Instead, there was a loose congregation of national banks, chartered by the federal government, state banks, chartered by individual states, private banks, savings banks, trust companies that were not really banks, but behaved like them, each operating according to its own lights, each following its own rules. What would a visitor from Europe observe in such a system? Perhaps confusion first, and then a kind of creeping unease. Paul would have noticed that when a bank in one city needed currency or credit, there was no central authority to turn to, no lender of last resort standing ready with calm authority to restore order. The money supply itself was inelastic, tied rigidly to the supply of gold and the circulation of national banknotes, neither of which could expand or contract smoothly when businesses needed capital or when panics created sudden drains. If there was a harvest failure in the Midwest, if there was a crop that needed financing, banks had to arrange among themselves somehow, moving money in clumsy, inefficient ways. The whole system had a kind of improvised quality, like a great machine assembled from parts that were not designed to fit together. Hamburg had taught him something different. The German Reichsbank, which had been established after unification, had a central role in managing the nation's credit. It could expand the money supply when it was needed, contract it when inflation threatened. It was a respectable house. In other words, not because of grand architecture or high walls, but because it had authority and foresight. It could see the whole picture and act accordingly. The Bank of England, ancient and sure of itself, performed a similar function across the Channel. When Paul studied their operations, he was studying not exotic or experimental systems but the evolved wisdom of European finance over centuries. What compelled him initially, perhaps, was not yet a political conviction, but something more like an aesthetic discomfort. Here was a nation growing in power and wealth at an astonishing rate, yet its financial system had the character of improvisation, of frontier traditions persisting long after the frontier had settled into cities and factories. The American financial system worked most of the time, or seemed to, because the underlying economy was so robust, so naturally productive, that it could almost afford to be inefficient. But efficiency was not the only virtue of a banking system. Safety mattered. Stability mattered. The confidence that capital would flow where it was needed without catastrophic interruptions mattered deeply. Schiff had brought Paul into Warburg Co, initially as a partner, and the firm was a window onto American high finance. But it was a window that revealed the gaps and inadequacies as much as it revealed opportunity. Schiff himself was a formidable figure, a man who commanded great respect, and yet even his firm, powerful as it was, could not single-handedly manage the risks that arose when the banking system fractured under pressure. How was any private bank, no matter how wise or how well capitalized, supposed to shore up the whole structure when it began to fail? The answer, Paul would gradually come to believe, was that it could not. It should not even be asked to try. These years of the early 1900s were years of quiet observation and study for him. He did not yet speak in public forums about his concerns, did not yet position himself as a reformer or a visionary. Rather, he read deeply in the history and theory of banking. He observed the operation of American markets, attended lectures and discussions, spoke with men who understood finance from the inside. He was making an inventory of the problems, filing them away in his memory like specimens in a collection, waiting for the moment when someone might ask him what he had seen, what he had learned, what he thought might be done about it. Did he feel, in these years, like an outsider? Perhaps a banker steeped in European tradition, looking at American practice and finding it wanting, is bound to feel some degree of separation, some sense of standing apart and observing. Yet this position of partial outsiderness, of seeing a system with fresh eyes, would eventually become an advantage. The Americans, immersed in their own traditions, might not see the problem because it had always been that way. But Paul Warburg had seen another way, a better way, and that vision would come to matter more than anyone, perhaps even he himself, could have predicted on the day he first arrived. The world of finance, we might say, breathes. It expands and contracts. It runs on confidence the way your lungs run on air, and when that confidence falters, even for a moment, the entire system gasps. To understand why Paul Warburg came to America with such urgency, why he became convinced that something fundamental was broken, we must drift backward into October of 1907, to a time when that confidence nearly stopped altogether. Picture, if you will, a Tuesday morning in New York. The sun rises as it always does over Manhattan, illuminating the granite facades of banks and trust companies lining the financial district. But something in the air feels different. Something in the way men move from their offices to the streets, the way conversations drop to whispers, the way eyes dart toward the ticker machines where stock prices are being reported. There is no single moment when panic begins. It does not arrive with a bell or a trumpet. Instead, it seeps in like water through the cracks of a foundation, building and spreading until the entire structure shudders. In the years before 1907, America's economy had been stretching. Growth, expansion, optimism. The country was young and restless, full of appetite for railroads and speculation, for the new fortunes that might be made in oil and steel and land. Banks had been lending freely. Trust companies, which were less strictly regulated than banks proper, had been taking greater and greater risks, investing depositors' savings in stocks and bonds and ventures that promised spectacular returns. It was a time of what we might call exuberance, though the men of Wall Street preferred other words. They spoke of prosperity, of progress, of the natural order of things. But underneath that confidence, small tremors were beginning to register. In the spring of that year, the stock market had declined sharply. Money had become tighter. Some of the large banks had begun to pull back their lending. It was nothing catastrophic, nothing that most ordinary Americans would have noticed. Yet among those who watched the markets closely, among the traders and brokers and depositors who kept their savings in trust companies rather than banks, anxiety was quietly gathering. What if the prosperity was not as solid as everyone had assumed? What if the risks that had been taken were somehow greater than anyone had admitted? On October 22nd, a Tuesday, a rumor began to circulate. It was a small thing at first, the kind of whisper that moves through a financial district the way wind moves through leaves. A large brokerage house had failed, or was about to fail, or was connected to someone who had failed. The details were hazy, uncertain. Perhaps no one even knew the precise truth anymore. The rumor itself became more important than whatever fact might have spawned it. And in that moment, fear began to crystallize into something more solid, more urgent than mere anxiety. By Wednesday morning, depositors had begun to line up outside the Trust Company of America, not because they had any specific knowledge that the bank was in trouble, but because rumor had said so, and rumor, in a time of uncertainty, feels like truth. These were ordinary people, shopkeepers and clerks and widows whose life savings were held in the vault. They came with their passbooks in hand, asking to withdraw their money. The tellers behind the counter worked as quickly as they could, but the line only grew longer. More people arrived with each passing hour. More people who had heard the rumor, who feared they might lose everything if they did not retrieve their deposits now, before the bank's reserves ran dry. This is the terrible mathematics of a bank run. Each withdrawal makes the bank slightly weaker. Each withdrawal makes the next depositor slightly more frightened. The fear feeds upon itself, growing and accelerating. It does not matter whether the bank was actually sound at the beginning of the day. It does not matter what assets it might have held in reserve. Once fear has taken hold, once people believe that others will withdraw their money, they become compelled to withdraw their own money, and their fears become self-fulfilling prophecies. The bank fails not because it was ever insolvent, but because everyone simultaneously wants their money back, and no institution can meet that demand. The run on the Trust Company of America lasted through Thursday and into Friday. The bank's reserves, which had seemed adequate on Monday morning, dwindled with terrifying speed. By Friday afternoon, the bank was near the point of collapse. The managers made desperate appeals to other bankers, to men of influence and capital who might come to their aid. And some did. A consortium of banks, coordinated by the great J.P. Morgan himself, agreed to provide emergency loans. The money arrived, and the immediate crisis passed. But the panic did not end. It merely spread, like water finding new channels. If the Trust Company of America could nearly fail, depositors reasoned, what about the other trust companies? What about the banks that held their savings? By the following week, runs had begun at other institutions. Long lines formed on corners. People pushed forward, clutching their passbooks and their fears. The stock market had fallen dramatically. Securities that had seemed valuable became nearly worthless. Men who had felt wealthy on Monday felt ruined by Friday. Some did lose everything. Others, by extraordinary luck or quick thinking, managed to withdraw their savings in the chaos before the doors closed. The fear that moved through Wall Street in those weeks also moved through ordinary neighborhoods. A factory worker worried that his wages, deposited in a local bank, might evaporate. A school teacher thought about the modest savings she had accumulated over years of modest work. Parents wondered if they might lose the money they had set aside for their children's education. The panic was not abstract. It was not confined to marble halls and ticker machines. It reached into the homes and the hearts of millions of people who had not known, before 1907, how fragile the entire system truly was. It felt, in those frightened days, as though the entire world of money might simply dissolve. The crisis would be contained, eventually. The intervention of the great banking houses, most notably the power and prestige of J.P. Morgan, stabilized things. By December, the acute panic had subsided, but something had shifted in people's minds. The confidence had been broken, and even when it was restored, it never felt quite the same. The questions that had been raised lingered in the air like smoke. Why had this happened? Why was the system so vulnerable? Why could the entire financial apparatus of the nation be shaken so violently by rumors and fear? And, perhaps most importantly, could it happen again? In Hamburg, when word of the panic reached the Warburg family, Paul would have read the reports with a particular kind of attention. He was watching America with the eyes of a banker trained in a more centralized system, a system where a central bank could act as a stabilizing force, as a lender of last resort. He was seeing, in the chaos of 1907, the precise problem he had come to America to understand, and he was beginning to form the conviction that would shape the next 6 years of his life, that something fundamental needed to change, and that he might be the one positioned to help change it. In the autumn of 1910, a small party of men gathered on a railway platform in New Jersey, with the kind of discretion usually reserved for affairs of state or matters of delicate honor. They had been summoned, somewhat mysteriously, by Senator Nelson Aldrich of Rhode Island, one of the most powerful men in American finance and politics, and the journey ahead would take them south, through the darkness, to an island off the coast of Georgia that few Americans had ever heard of. The men spoke in low voices as they boarded the private rail car, aware, even then, that what they were about to discuss should remain, for now at least, beneath the surface of public knowledge. Paul Warburg was among them, though his presence there carried its own particular weight, for he was the German immigrant banker with fresh eyes and deep knowledge of how central banking actually functioned in the old world, knowledge that America, in its fragmented banking chaos, had never quite managed to acquire. The destination was Jekyll Island, a place of quiet privilege, owned by a cluster of the wealthiest families in America, men whose fortunes dwarfed even those of the Warburgs, though the Warburgs were beginning to understand that capital, after all, was far less about the absolute number of dollars than about the networks through which those dollars flowed. The journey itself, hours moving through the southern night, created a kind of enforced intimacy among the travelers. There was Senator Aldrich himself, silver-haired and accustomed to moving through rooms with the assumption that what he desired would come to pass. There was Henry Davison, a partner of the House of Morgan, a man whose name was nearly synonymous with American banking power, and whose bearing suggested that he had never seriously doubted his own judgment in matters of consequence. Benjamin Strong was there as well, a figure less famous perhaps than some of the others, but whose intelligence and grasp of monetary mechanics would prove essential to what they were about to undertake. And others joined them, men of capital and influence, gathered for a purpose that was not quite admitted, even among themselves, with full transparency. Why the secrecy, one might ask? Why not simply convene Congress? Why not hold open hearings in the light of day? The answer lay partly in the political moment itself. The American public, in the aftermath of the Panic of 1907, harbored a deep and justified suspicion of the very bankers who were now gathering to design a fix. There was a genuine populist sentiment abroad, a feeling that the money power concentrated in Wall Street had become something bloated and dangerous, something that placed the fortunes of ordinary people at risk whenever the whims of speculators shifted. To openly announce that a cabal of the nation's richest men were meeting to design a new financial architecture would have provoked an immediate and probably insurmountable outcry. And so the discretion, the private rail car, the island retreat, these were not merely affectations of power, but practical necessities in the delicate work of reshaping a nation's relationship with money. The island itself seemed almost designed for such a purpose. Jekyll Island had about it the quality of another world, a space removed from ordinary American life, surrounded by water, accessible only by causeway or boat, a place where conversations could unfold without the constant possibility of interruption or the anxious presence of journalists hunting for story. The club there was comfortable but not ostentatious by the standards of the ultra-wealthy, and the men settled into its rooms with the sense that they were embarking on something that required sustained thought and careful deliberation. There were no stenographers present, no official record was kept, or if one was, it remained hidden for decades, a small detail that would later fuel all manner of speculation and conspiracy theory. But this too was practical. These men were not attempting to hide anything fundamentally nefarious. They were attempting to think freely, without the constant pressure of having each word recorded and later scrutinized by people who lacked the full context of their reasoning. Paul Warburg, in those rooms, occupied a curious position. He was American now, or at least he had taken on American citizenship, but he remained European in his sensibilities and his training. He had spent years studying the workings of the German Reichsbank, had apprenticed himself to its mysteries, had observed how a central bank could smooth the flow of credit through an economy, could dampen the wild swings of speculation and panic, could serve as a kind of national financial nervous system, conveying signals and stabilizing impulses throughout the whole body of commerce. The other men in those rooms had no such background. They understood American banking, or rather, they understood the particular American system of fragmented, competitive, often antagonistic banks that had grown up in the decades since the Civil War. But none of them had really studied how banking worked in other places, or thought deeply about what the alternatives might be. The work of Jekyll Island, over those quiet days in late autumn, was to reconcile two very different impulses. On the one hand, there was the American tradition, rooted in a deep historical suspicion of central authority and concentrated power, which had led to the creation of what was really no central banking system at all, but rather a collection of independent institutions, each pursuing its own interests. On the other hand, there was the evident fact that this system had repeatedly failed. It had produced panics. It had created situations in which credit simply vanished from the economy, in which businesses could not access the funds they needed to continue operating, in which depositors queued anxiously outside banks wondering if their savings would survive the day. Warburg understood something that the men around him were only beginning to grasp, that a modern industrial economy required a kind of breathing mechanism, a way of expanding and contracting the money supply in response to genuine needs, rather than leaving everything to chance and the appetites of competing private bankers. What emerged from those discussions, slowly and through considerable debate and disagreement, was a plan, not yet a blueprint, but something approaching one, for what would eventually become the Federal Reserve System. It was a compromise document in many ways, a structure that tried to accommodate the American distrust of centralized power, while nonetheless creating something that could function as a central bank in practice. There would not be a single, all-powerful board dictating monetary policy from a marble temple in Washington. Instead, there would be multiple regional reserve banks, distributed around the country, each one serving the banks and businesses of its region, with a coordinating board in the center, but not a board with absolute authority. It was an ingenious design, in its way, or perhaps it would be more honest to say that it was a design born of necessity, of trying to solve an urgent problem while navigating the shoals of American political ideology. Warburg found himself, in those conversations, offering the quiet authority of his European knowledge, while remaining acutely aware that his opinions, his suggestions, could only carry so much weight. He was, after all, a foreign banker, a German by birth, and there remained in the American consciousness a certain anxiety about foreign influence on American finance. He proceeded, therefore, with a careful patience, offering observations rather than declarations, asking questions that led the other men toward conclusions that Warburg himself had already reached through his study of European practice. It was a kind of intellectual diplomacy, a recognition that in America the best ideas were those that the powerful believed they had discovered themselves. The discussions ranged widely across the landscape of financial theory and practice. There was the question of what such a system should do during a panic. Should it expand credit freely, offering a kind of financial morphine to soothe the markets? Or should it maintain a certain stern discipline, allowing weak banks to fail, accepting a degree of pain in order to prevent what might be seen as moral hazard, the encouragement of reckless behavior? Warburg leaned toward the view that some expansion of credit during a panic was both necessary and appropriate, that the whole point of having a central bank was to prevent the kind of vicious downward spiral that had characterized previous American panics. But he also understood the conservative view, the fear that appearing too generous in moments of crisis would encourage speculation and recklessness in normal times. These were old debates in European banking circles, and they were being recapitulated here, in the depths of a Georgia autumn, by men who were discovering them perhaps for the first time. There was also the question of what exactly a central bank's relationship to the government should be. Should it be entirely private, owned by the banks, run essentially as a business for the benefit of its shareholders, or should it be a public institution, answerable ultimately to the nation and its elected representatives? The Jekyll Island group gravitated, perhaps inevitably, toward a kind of hybrid solution, a system that was nominally public, created by an act of Congress, but which would nonetheless be substantially influenced and shaped by the private banking community that it was meant to regulate. It was a compromise, as so much in American governance is, and like many compromises, it contained within it the seeds of future conflict and misunderstanding. As the days passed on that island, as the men talked through meals and in the evenings, moved between various rooms discussing details and larger principles, something like a consensus began to form. Nothing was written down in any official capacity, or if it was, those notes were carefully guarded. But the outlines of a new system began to take shape. It would be several years yet before this outline could be translated into actual legislation, before it could be debated in Congress, and modified and compromised until it bore only a partial resemblance to what had been discussed in those quiet rooms on Jekyll Island. But the fundamental insight, the basic architecture, had emerged from those conversations. America needed a central bank, even if it insisted on calling it something else, even if it distributed its power among multiple regions and multiple boards, rather than concentrating it in a single location and institution. America needed a mechanism for managing credit, for stepping in during panics, for providing the kind of steady hand that individual banks, acting in their own self-interest, could never provide. Paul Warburg left Jekyll Island quietly, as he had arrived, without fanfare or announcement. The journey back north was made in the same private rail car, the same deliberate discretion. But within him now was a sense of purpose, a clarity about the work that lay ahead. He had arrived in America some years before as a banker seeking to understand a new market, to expand the reach of his family's firm. He was leaving Jekyll Island with a much larger mission, to reshape the entire financial foundation of the nation, or at least to offer the knowledge and perspective that might make such a reshaping possible. He understood that this work would be slow, that it would require patience and careful argument, that it would demand that he navigate between the genuine insights of European banking science and the democratic ideals and suspicions that shaped American political thought. But he also understood, with a kind of quiet certainty, that the work was necessary and that he had the knowledge and temperament to help see it through. What Paul Warburg faced upon returning to the center of American financial debate was not hostility so much as bewilderment, a kind of polite incomprehension that Americans seem to harbor toward the very concept of centralized banking. The Jekyll Island scheme, though its participants believed they had crafted something revolutionary, remained mostly whispered knowledge in the highest circles. The broader public, and indeed many in Congress, still clung to the belief that America's decentralized banking system was not a weakness, but a virtue, a safeguard against the very tyranny that centralized power in Europe had come to represent. And so Paul Warburg, this quiet, methodical immigrant with his careful accent and his European manner, undertook what might be called the most patient missionary work in American financial history. He did not rush, he did not shout. He moved, instead, through the slower machinery of persuasion, the academic lecture, the careful letter to influential newspapers, the patient testimony before committees that often seemed skeptical of his very presence, much less his ideas. Where another man might have pushed with the weight of his banking connections or the insider knowledge he carried from Jekyll Island, Warburg chose a different path entirely. He began to educate, methodically and without condescension, explaining to Americans what central banks actually were, what they were not, and why the absence of one had nearly destroyed the country in 1907. There was something almost mathematical in his approach, as though he were teaching geometry to a student who had never seen a diagram. He would begin with the simplest premises. A central bank, he would explain in his measured tone, was not a superbank designed to crush smaller competitors. It was, rather, a bank for bankers, an institution that could hold reserves in times of plenty and deploy them in times of crisis, the way a fireman held water until the moment came when fire threatened. The image was not his own invention, but he wielded it with the precision of someone who had lived through enough crises to understand their anatomy. He knew that fear of centralized power ran deep in the American character, especially among the merchants and farmers in the heartland, who had watched the Eastern financial establishment make decisions that rippled outward and seemed to touch them only in their losses. His writings began to appear with increasing frequency, measured pieces in financial journals, careful op-eds in major newspapers, speeches at banking conventions where his dignity and thorough knowledge slowly, almost imperceptibly, began to shift the tenor of the room. There was a kind of courtliness to his method. He would not dismiss American objections as mere ignorance. Instead, he would pause, acknowledge the legitimacy of the fear, and then gently show how the fear itself was based on misunderstanding. He seemed to recognize that in a democracy, public opinion mattered in ways it did not in Europe, and that no amount of financial logic would matter if the American people remained convinced that a central bank meant the end of their independence. What made Warburg's campaign distinctive was his willingness to engage in the language of American values rather than impose European banking theory wholesale. He did not speak of the Bundesbank or the operations of the Banque de France as though America should simply imitate them. Instead, he framed the central bank as something that would protect American liberty precisely by preventing financial panics that destroyed ordinary people's savings and livelihoods. He understood, in other words, that Americans needed to see how a central bank would serve them, not merely the banking establishment. The audiences he addressed were often resistant. Congressional committees filled with men who represented agricultural districts or small-town manufacturing interests viewed Wall Street with suspicion that sometimes bordered on hostility. The phrase Wall Street monopoly carried real political weight, and here came Paul Warburg, a man who had arrived in America as a representative of foreign banking interests, asking them to accept the very kind of centralized financial authority they had been taught to fear. The irony was surely not lost on him, though he would never have commented on it directly. Instead, he persisted with the quiet determination of someone who believed that understanding would eventually overcome prejudice. He cultivated relationships carefully. Influential academics began to study his analyses. Progressive politicians, who distrusted Wall Street but cared deeply about economic stability for ordinary people, found in Warburg's arguments a way to support central banking without appearing to surrender to Eastern financial power. Journalists who initially approached him with skepticism discovered that his explanations were actually comprehensible, that he did not speak down to them or deploy financial jargon as a weapon. There was something almost disarming about his directness, combined with his courtesy. Year after year, as the memory of the Panic of 1907 faded, but its lessons remained fresh in the minds of those who had lived through it, Warburg's message began to find purchase. His pamphlets were read, his testimony was noticed, the repetition, the unflagging consistency, the absence of bombast, these things wore down resistance the way water wears down stone, slowly and inexorably. He never claimed certainty about the future. He never promised that a central bank would prevent all crises forever. What he did was explain, with meticulous care, how a properly designed system could reduce panic, provide stability, and serve the long-term interests of the American economy and the American people. The men in Congress who had dismissed him began to reference his work in their own speeches. Newspaper editorialists who had scorned the idea of a central bank 5 years earlier began to acknowledge that perhaps something needed to change. The shift was not dramatic or sudden. It happened the way most real changes in public opinion happen, through the patient accumulation of understanding, through repeated exposure to a carefully constructed argument, through the slow erosion of fear when met by someone who refused to respond with contempt. What Warburg had essentially done over these years of his careful public campaign was to translate European financial architecture into American democratic language. He had made himself, in a sense, a bridge, not abandoning his knowledge or his immigrant perspective, but learning to speak across the divide between old-world banking and new-world skepticism, and perhaps that very position of in-betweenness, of standing in both worlds and comprehending both, gave him a kind of credibility that a native-born American banker might never have possessed. For how could a man who had come to America and embraced it truly be working against American interests? This unspoken logic seemed to work in his favor as the years progressed and the decade moved forward. Yet even as Paul Warburg's words found their way into newspapers and congressional corridors, the path toward any actual legislation remained tangled and uncertain. The year was 1911, and America was not yet convinced that it needed a central bank at all. For more than a century, the nation had resisted such a thing, seeing it perhaps as a relic of European aristocracy, a tool for concentrating wealth in the hands of a few. And so the debates began, long, patient, sometimes heated conversations in marble halls and committee rooms where the future of American finance hung in a careful balance. The political landscape itself was fractious. On one side stood the progressives, who feared any banking system that might consolidate power among Wall Street's elite. On another side were the conservatives, who worried that too much government involvement would stifle the natural flow of markets. And then there were the bankers themselves, who could not agree among themselves what sort of central institution would truly serve their interests. Some wanted a single, monolithic bank. Others feared such concentration and preferred a network of regional reserves. Paul Warburg, with his patient diplomatic temperament, found himself in the curious position of mediating between these camps, not as an official negotiator, but as a voice of reason drawing on decades of European precedent. The conversations were slow, methodical. Listen to the rhythm of compromise, and you will hear something almost musical in its way. A concession here from the bankers, a reassurance there for the progressives. Senator Nelson Aldrich, who had chaired the National Monetary Commission and whose name had become synonymous with the conservative banking establishment, found himself gradually moving toward accepting the principle of a central banking system, though he insisted, as did many of his allies, that any such system must remain firmly in private hands. The bankers themselves, meanwhile, worried that any institution bearing the word federal in its name might invite government meddling, yet they also understood that public confidence was essential. By 1912, the Democratic Party, sensing political advantage and drawing on the intellectual energy of figures like Louis Brandeis and President Woodrow Wilson himself, began to shape a vision that would be fundamentally different from what Aldrich had proposed. Where Aldrich had imagined a single central bank, the Democrats envisioned something more distributed, more federal in the truest sense, a network of regional reserve banks, distributed across the country, each operating with some independence, yet coordinated by a central governing board. It was, in many ways, a stroke of political genius. It addressed the deep American suspicion of concentrated power while still creating the institutional machinery for coordinated monetary management. And it did something else as well. It acknowledged that America was no longer simply a collection of regional economies, but a genuinely national financial system that required genuinely national oversight. Paul Warburg watched these developments with a mixture of satisfaction and concern. The architecture being described was sound, he believed. A decentralized system of regional banks would actually address many of the vulnerabilities that had produced the Panic of 1907. But he also worried about the details, about whether the compromise being forged would genuinely empower the system to function effectively, or whether political concessions had left it hobbled and ineffectual. The debates grew more intense as the bill itself took shape. Questions emerged that had no easy answers. Should the Federal Reserve System set its own monetary policy independently, or should it remain subordinate to the Secretary of the Treasury? How many regional banks should there be? 5, 8, 12? How should their boundaries be drawn? Which cities would house them? In an era when transportation could take days and communication moved at the speed of telegraph, these seemed like questions of practical geography. But they were also questions of power and prestige. Would a Federal Reserve Bank be established in Chicago or St. Louis or Kansas City? Each city's bankers lobbied fiercely for inclusion. There were fierce arguments about the role of gold. Gold, to the minds of many politicians and bankers alike, represented solidity, stability, the physical foundation of monetary value. Some believed the Federal Reserve should be bound absolutely by gold reserves, prevented from issuing currency beyond a certain multiple of the gold it held. Others argued that such constraints would make the system inflexible, unable to respond to genuine crises. These were not merely technical disputes. They reflected fundamentally different philosophies about the proper relationship between money, value, and trust. Could you create real value through the careful management of credit, or was all money ultimately an illusion unless backed by something tangible and precious? Paul Warburg, drawing on his European experience, argued for the necessity of elasticity, the ability of the system to expand credit, when demand was genuine and contracts warranted it, and to contract when excess had accumulated. But the concept of elastic currency made many Americans deeply uneasy. Elasticity seemed to imply a kind of monetary manipulation, a deviation from the natural order. How could you trust that the managers of such a system would not simply inflate the currency for their own enrichment? Through all these debates ran a current of anxiety about the very men who would administer the system. Wall Street, to many Americans, was a place of mystery and moral suspicion. Were these banker operators trustworthy? Could they truly be expected to manage the nation's currency for the public good, or would they inevitably favor their own interests and those of their wealthy clients? The presence of men like Paul Warburg in the discussions did not entirely dispel these worries. Indeed, for some critics, it confirmed them. Here was an immigrant banker, connected to international finance, advising on the creation of America's central bank. The xenophobic undertones of such suspicion rarely remained entirely submerged in the political rhetoric. Yet slowly, over the course of 1912 and into 1913, a consensus began to crystallize. The progressives had secured enough concessions to feel that the system would remain accountable to elected officials. The bankers had secured enough assurance that the system would genuinely serve the needs of commerce and credit. And most fundamentally, nearly everyone had come to accept that some form of central coordination was simply necessary. The American economy had grown too large, too complex, too interconnected, to be left entirely to the spontaneous workings of thousands of independent institutions. The Federal Reserve Act itself, when it finally took shape in the spring of 1913, was a document of genuine compromise. It established a system of 12 Federal Reserve banks, distributed across 12 regions of the country, each with its own board of directors drawn from local bankers and business leaders. Overseeing these regional banks was a Federal Reserve Board in Washington, composed partly of government officials and partly of representatives appointed for their financial expertise. The system would hold gold reserves and the deposits of member banks, and it would have the power to lend to banks in times of stress, creating an elastic supply of credit that could respond to genuine needs. There was an irony, quiet but unmistakable, in the architecture that emerged. The system's very distribution, its very commitment to preventing any single concentration of banking power, meant that it would require careful coordination to function effectively. The regional banks would have to cooperate with one another, and that cooperation would have to be mediated by the board in Washington. This was not precisely what any single faction had wanted. It was not what Paul Warburg ideally would have designed. But it was workable, and more importantly, it was what the American political system could actually produce and accept. When President Wilson signed the Federal Reserve Act on December 23, 1913, he did so believing that he had solved one of the great problems of American finance, while preserving the essential checks against concentrated power that the nation's founding documents had enshrined. It was, in a sense, the perfect expression of American political compromise, a solution that worked precisely because it was not perfectly efficient, because it distributed power among competing interests and required them to cooperate for the system to function at all. Whether that very distribution would, in some future crisis, prove to be a source of strength or paralysis, no one could yet know. When President Woodrow Wilson signed the Federal Reserve Act on December 23, 1913, in a quiet room at the White House, the machinery of American banking began its slow transformation into something it had never been before. A central bank, a nervous system for the nation's money. And within months, as the governing board of this new institution took shape, Wilson faced a question that would have seemed impossible just a few years earlier. Whom should he appoint to help steer it? Among those he chose was Paul Warburg. The appointment arrived in the spring of 1914, and in some corners of Washington and New York, it landed like a small stone into still water. Not with outrage, that would come later, in darker times, but with a kind of bemused recognition. Here was a man born in Hamburg, a German banker by training and temperament, now holding one of the most intimate seats at the table where America's money supply would be decided. The irony was not lost on those who had fought so fiercely against central banking, who had seen in Warburg's very foreignness a confirmation of their deepest fears, that American finance was being handed to outsiders, to those with divided loyalties and old-world allegiances. Yet there he was. Warburg had not sought the position with obvious ambition. His role in the Federal Reserve Act itself had been deliberately, almost scrupulously, behind the scenes. He had testified before Congress, yes, but with a restraint that puzzled some observers. He could have demanded credit, could have stamped his name more boldly on the legislation that bore so many of his intellectual fingerprints. Instead, he had written memoranda. He had spoken quietly to congressmen in hallways. He had allowed others, Senator Carter Glass, Representative Henry Bascom Parker, to take the public credit, while he remained, in his own way, a ghostly presence in the drafting rooms. This had been deliberate. Warburg understood something about American politics and the American temperament that many of his European colleagues did not. Visibility could be a liability. A foreign banker's name too prominently attached to the Federal Reserve might have doomed it in the Senate. The fear of foreign control, of money flowing eastward toward European capitals, ran too deep. So Warburg had made himself useful without making himself obvious. And now, in being named to the board, he would be unable to hide any more. His appointment was announced on June 10, 1914. The newspapers treated it as a significant but not sensational matter. The New York Times reported it with the tone one might use for a promotion of a reliable civil servant, careful, factual, noting his experience but dwelling little on the strangeness of it. He was 50 years old. He had lived in America for 12 years. He had become, in all but the formal sense, an American businessman, though he retained his German citizenship and his Hamburg accent never entirely left him. The Federal Reserve Board itself was a modest affair in those early days. There was no grand marble building yet, no imposing headquarters. The board members worked in cramped offices, learning as they went, inventing the procedures and protocols of central banking almost as they moved through their days. Warburg was one of 7 board members, alongside the Secretary of the Treasury, the Comptroller of the Currency, and 4 private citizens appointed by the President. Bankers and businessmen meant to bring practical knowledge to the theoretical work of monetary management. And here, perhaps, was where the deepest irony lived. Warburg had spent decades studying how other central banks worked, how the Bank of England managed credit, how the Reichsbank responded to crises, how the mechanisms of confidence and reserve requirements held the whole delicate structure together. He had written about it extensively, in academic papers and banking journals, in terms so technical that they seemed to float above the heads of ordinary Americans. Now, suddenly, he was not writing about central banking in theory, he was doing it, making decisions that would ripple outward, affecting the amount of credit available to farmers in Nebraska, the interest rates paid by businessmen in Chicago, the deposits held by families trying to save something for their children's future. The weight of this must have pressed upon him in ways that are difficult now to fully reconstruct. Here was a man who had always worked in the background, who preferred the company of ledgers and correspondence to public ceremony, now thrust into a position where his decisions would matter to millions of people he would never meet. Americans who had no idea who he was, who might have resented him had they known his origins, would feel the effects of his judgments about money and credit and the pace of economic growth. His colleagues on the board held him in high regard, it seems. They recognized his knowledge. But there is something touching in how little the historical record tells us about his actual feelings during this period. Did he feel vindicated? Did the appointment seem to him like a confirmation that an immigrant could truly belong to America, could serve it not as an outsider, but as a full participant in its governance? Or did he carry with him, always, a sense of provisional belonging, an awareness that his position depended entirely on continued goodwill, on the continued belief that he could be trusted with something so fundamental to the nation's well-being? There are hints in his later writings, in letters to family members, that Warburg felt the weight of representation. He was not merely Paul Warburg, banker and monetary theorist. He was a symbol of successful immigration or of foreign influence, depending on one's perspective. He was a test case for whether a man born elsewhere, trained in different traditions, could truly understand the American spirit and serve it faithfully. The summer of 1914 brought other concerns that would soon push questions of identity and loyalty into sharp relief. In Europe, the assassination in Sarajevo had set in motion a chain of events that would reshape everything. By August, the Great War had begun, and the Warburg family, split across the Atlantic, would find itself torn in ways that no appointment to any board of governors could have prepared them for. But for now, in these early months of his service, Paul Warburg sat in meetings where he helped determine how much credit American banks could extend, how quickly the nation's money supply would grow, what the discount rate would be. He was shaping, in his quiet way, the monetary heart of a nation that had always been skeptical of men like him, and perhaps that was the truest irony of all, that the outsider had become indispensable, not despite his foreignness, but, in some sense, because of it. He saw what Americans could not yet see about their own financial system, because he had learned to think like both a Hamburg banker and an American businessman, moving between two worlds with a fluency that few possessed. Now, imagine, if you will, a morning in the spring of 1914, not long after the Federal Reserve's doors had opened for the first time. The building itself stood in Lower Manhattan, a fortress of marble and oak, but inside, in the quieter chambers away from the public halls, something quite different was happening than the rushing, frantic trading that New Yorkers associated with their banks. The rhythms here were deliberate, measured, almost ceremonial in fact, like the ticking of an enormous clock that had just been wound and set to govern the entire machinery of American commerce. To understand what was truly being born in those early months requires us to step back and think about something so fundamental we rarely name it: money itself. What is it, really? It is, at its heart, a collective agreement, a promise. When you hold a dollar bill, you are holding a piece of paper upon which numbers are printed and a government seal is stamped. What gives that paper any value is the shared belief, held by millions of people you will never meet, that someone else will accept it from you tomorrow. That is the essence of money. It is trust made tangible. And the Federal Reserve, in its inception, was designed to be the guardian of that trust, the institution that would ensure that promise never broke under strain. Think about what had happened in 1907, only 7 years before. Banks failed suddenly, without warning. Customers rushed to their windows demanding gold, demanding actual metal they could hold, and the banks did not have enough. The tellers pulled their iron gates shut. The money, you see, had been an illusion the whole time, or so it seemed in that moment of panic. Most of what existed was not gold or silver locked in vaults, but rather promises on paper, promissory notes, ledgers. In the crisis, everyone wanted to be paid in the real thing at once, and the system simply could not accommodate it. The Federal Reserve was built, in large part, to prevent that moment of collective disillusionment from ever happening again. So, how did it work, this new institution? On the surface, it seemed almost simple. The Federal Reserve would be a bank for banks, commercial banks across the country, instead of holding all their reserves of gold and cash in their own vaults, would deposit those reserves with the Federal Reserve. The Reserve would pay them interest on those deposits, a gentle incentive. In return, the Fed held that gold, that currency, in centralized locations. There was a main vault in New York, of course, but there were also regional Federal Reserve banks in other cities, in Boston and Philadelphia, in Chicago, in San Francisco, 12 regions in all, a geographical spreading of responsibility and power. When a business in Cleveland needed to pay a business in Atlanta, the two local banks involved did not need to physically ship gold or currency back and forth across the country. Instead, their accounts with the Federal Reserve would be adjusted. Numbers would change on a ledger. The Cleveland Bank's reserve balance would decrease by the amount owed. The Atlanta banks would increase by that same amount. The actual transfer of value happened through accounting, through trust between institutions. Is this not curious? The very crisis that had panicked people into demanding gold was solved, or so the theory went, by making the transfer of money even less tangible, even more purely abstract. There was another function, equally crucial, and this is where Paul Warburg's careful study of the European central banks became tangible policy. When a commercial bank found itself temporarily short of reserves, it could come to the Federal Reserve's window and borrow money. But here is the key. It could do so not on its own terms, but on the terms set by the Fed. The Federal Reserve would charge an interest rate, what came to be called the discount rate. If the Fed raised that rate, borrowing became more expensive, and banks would lend less freely to businesses. If the Fed lowered it, borrowing became cheaper, and lending would increase. Through these levers, the Federal Reserve could influence the amount of money and credit flowing through the entire economy. It was not, technically, controlling the money supply directly. Rather, it was adjusting the incentives at the margin, nudging banks toward lending more or less as circumstances warranted. This mechanism emerged from a profound insight. The economy was not something that could be left entirely to its own devices. Crashes and runs and panics were not merely individual failings, they were systemic phenomena. A bank that was fundamentally sound could fail simply because customers believed it might fail, and once that belief took hold, it became self-fulfilling. The only way to prevent it was to have an authority that could credibly promise that reserves would be available when needed. The Federal Reserve was that authority. Its mere existence, its very ability to lend to banks in distress, made distress less likely to occur. In those early months and years, the Fed's staff worked in a kind of beautiful chaos, learning their craft as they went. No such institution had existed in America before. There were precedents in Europe, yes, but translating them into an American context required invention. The Federal Reserve had to establish protocols for evaluating the collateral banks offered when they borrowed. If a bank came to the discount window with a handful of commercial paper, promissory notes from businesses, the Fed had to decide, was this a sound loan that could safely circulate at the Fed itself? Or was it paper that only the lending bank believed in, and therefore unsafe? A whole language of finance had to be developed to answer such questions. There was also the subtle matter of opacity. The Federal Reserve, by its design, did not exist in the light of day the way Congress did. Its decisions were made in rooms where only bankers, businessmen, and a handful of policymakers gathered. The public had no direct vote on its actions. Some observers, even at the time, felt uncomfortable about this. A private institution was being granted public authority. A cartel of banks was being asked to self-regulate through a federated system. Yet there was a kind of logic to it, or at least a pragmatic wisdom. Markets require confidence, and confidence is fragile. Constant public debate, political interference, the pressure of elections and ideology, these things, it was felt, could undermine the careful calculations that banking required. Better to let the bankers and their advisors work quietly, guided by technical expertise rather than popular passion. And so the Fed began to move through its daily routines. Checks cleared between banks more smoothly. The discount window stood ready for those who needed it. Gold flowed in from around the world, attracted by the safety and stability the Fed now offered. The machinery of credit, which had ground to a halt in 1907, began to hum again. A small amount of inflation crept in, almost imperceptibly, and this was considered acceptable, even necessary. Better a gentle managed inflation than the alternative, a return to those terrible moments when money vanished from the system entirely, and ordinary people woke to find their life savings worth nothing. What had actually been created, though few realized it at the time, was a kind of central nervous system for American capitalism. The Fed was not running the economy. The market, competition, the independent decisions of millions of businessmen, these still drove the system. But now there was a monitoring function, a steadying hand ready to emerge from the shadows when panic threatened. The Federal Reserve, in its quietness, in its technical abstraction, in the purely numerical transactions that occurred within its walls, had become the modern answer to an ancient human fear. The fear that money, that trust made tangible, might simply evaporate. And in that answer lay the seeds of both stability and, as history would show, new kinds of fragility that would only become apparent much later. When summer came to Europe in 1914, the telegram wires began to hum with a frequency that would not quiet for 4 long years. The Warburg family, like so many families of their moment, found themselves distributed across a geography that was suddenly and terribly becoming enemy territory. And in that distributed silence lay a particular kind of sorrow, one that belonged to no single nation, but lived instead in the spaces between them, in the hearts of men who loved more than one country and could not say so aloud. Paul Warburg had made his home in New York now, a settled immigrant with American citizenship, a position on the Federal Reserve Board, a wife and children rooted in American soil. His brother Max remained in Hamburg, the steady hand at the helm of Warburg Co, a German banker, a man of Hamburg to his bones, with all the civic dignity and financial influence that implied. Felix, their younger brother, had also chosen America, his ties woven into the Kuhn-Loeb partnership and into New York's Jewish merchant elite. And yet their blood ran German. Their earliest memories spoke German in the rooms of their childhood. Their sense of financial honor had been forged in the conservative, methodical traditions of the Hamburg banking house. When Austria-Hungary issued its ultimatum to Serbia, when Russia mobilized, when Germany declared war, the world did not simply divide into 2 camps. It fractured, in the minds and hearts of those who had built bridges across its gulfs, into an impossible choice that no amount of rationality could resolve. Paul Warburg, sitting in his Manhattan office with the weight of the Federal Reserve Board upon his shoulders, understood with a clarity that must have felt almost like a curse what war on this scale would mean. He had studied European economies. He knew the delicate mechanisms by which credit flowed, by which trade sustained, by which whole nations fed themselves. He understood that the mechanism was about to shatter. Max Warburg, in Hamburg, watched the mobilization with an equally precise understanding, but his was inflected with responsibility toward his own people, his own nation. The bank had to function, the city had to be financed, Germany had to be supported. There is perhaps no more acute form of patriotism than the silent, daily work of keeping your country's financial system intact, while knowing intimately what the cost will be. The brothers did not speak for years, not because there was anger between them, though certainly there was confusion and perhaps a kind of helpless frustration, but because the machinery of war had rendered their private correspondence into a form of suspect communication. Letters took months to arrive, if they arrived at all, routed through neutral countries, opened and read by authorities who could not imagine a bond deeper than national loyalty. What would you write to a brother who now stood on the other side of a line drawn in blood? How would you express love without appearing disloyal? How would you maintain that earlier sense of family honor when your nation demanded that you regard that family as belonging to enemies. The silence itself became a form of presence. It lived in the offices and homes of both brothers, an ache that did not diminish with time but rather deepened, because silence in wartime accumulates. It becomes a weight. It becomes a question you cannot answer. Does my brother forgive me for choosing to remain on this side of the line? Does he understand that I did not choose anything, that I was chosen by circumstance, by marriage, by the momentum of my own life? Paul threw himself into work that must have felt, at moments, like a kind of penance. The Federal Reserve Board in wartime was not a place of quiet deliberation. America remained neutral in those first years, but American banks and American industrial capacity were already becoming crucial to the Allied war effort. Credits had to be extended, gold shipments had to be facilitated. The invisible machinery of American finance was transforming into an instrument that aided Britain and France, and by extension, opposed Germany. Paul Warburg, the immigrant banker, the man who had come to America to help stabilize its financial system, now found himself part of the mechanisms by which his native country would be slowly strangled. Did he lie awake at night? The historical record does not say, but one must wonder. A man of his intelligence, his financial acuity, his deep knowledge of international trade, could not have failed to understand the implications of what was flowing through his hands. He was, in a very real sense, helping to wage war on Germany. He was doing so in the abstract, through the mechanisms of finance rather than through any weapon. But finance is itself a form of power, and in wartime, power kills. Max Warburg, meanwhile, occupied a different sort of anguish. He was enlisted, in the way that powerful financial men are enlisted in wartime, into service to his nation. He worked to stabilize German finance as the war consumed resources and manpower at a rate that became increasingly unsustainable. He watched as the careful, methodical traditions of German banking began to strain under the weight of military expenditure. The bank endured, the city endured, but Max Warburg must have known, as any intelligent man would know, that the arithmetic was not favorable. A nation cannot sustain unlimited warfare without unlimited resources, and Germany, for all its industrial prowess and all the brilliance of its financiers, was ultimately limited. The blockade tightened, the resources dwindled. The calculation that must have haunted Max Warburg was not a comfortable one. And then, in 1917, America entered the war. The question that had been theoretical, which side would the Warburgs' adopted country ultimately support, became immediate and undeniable. America, now allied with Britain and France, was now explicitly at war with Germany. Paul Warburg's position became, overnight, precarious in a way it had not been before. A German-born banker on the Federal Reserve Board, a man whose brother was financing his native country's war effort, a man who could not publicly defend his loyalties or his family without appearing suspect. Paul Warburg had become, in the eyes of many, a potential enemy within. The terrible irony of it would have been impossible to miss. He had come to America to strengthen its financial system, and now he was regarded by some as a threat to it, not because of anything he had done, but because of where he was born and whom he loved. There is a photograph from some time in these years, the date is not entirely certain, that shows Paul Warburg's face with a weariness that seems to have settled into the bones beneath his skin. He had been a young man of ambition and intellectual confidence. The war and the division it created had aged him in a way that had nothing to do with the passage of years. He had lost, in some essential way, the thing that had brought him to America in the first place, the sense that he could move between worlds, could build bridges, could use his gifts and his learning in service to a larger, more rational good. The war had severed those bridges. It had forced a choice on men who had spent their lives trying to live in more than one place at once. Max Warburg survived the German war machine's demands, remained in Hamburg, kept the bank functioning through the impossible years of conflict. But when the war finally ended in 1918, when the armistice came and the machinery of battle at last stopped grinding, the world that both brothers had known had vanished as completely as if it had never existed at all. Germany, in defeat, was transformed into something neither of them could have anticipated. And the bonds between the brothers, tested in silence and separation, would soon face a trial far more severe than war itself. The war that was supposed to end all wars had instead opened a door to a room whose corridors seemed to stretch endlessly into darkness. For the Warburg family, the armistice of November 1918 brought not relief, but a peculiar, aching complexity. Max Warburg stood in the Hamburg offices of Warburg Co., surveying a landscape transformed almost beyond recognition. The German Empire had collapsed. The Kaiser had fled. Hyperinflation was beginning its slow, inexorable march through the currency, and the question that haunted every banker, every merchant, every person holding marks in their pocket was this: what remained to build upon? In those strange, trembling years after the guns fell silent, Max Warburg became something he had not anticipated he would need to become. Not merely a banker, but a healer, a stabilizer, a voice attempting to whisper reason into a nation convulsing with humiliation, hunger, and the raw terror of economic dissolution. He moved through the corridors of the Weimar Republic's fragile government, advising, counseling, warning of the dangers that lay in the chasm between resentment and reality. The reparations imposed by Versailles seemed not merely harsh, but alchemically designed to transform a nation's despair into something harder, darker, more dangerous. Max understood, perhaps better than most men of his generation, that money was not merely metal or paper or ledger entries. Money was confidence. Money was the collective agreement that tomorrow would mean something, that the baker would still bake tomorrow, that the farmer would still plant next spring. Without that confidence, the entire structure, which seemed so solid, so inevitable, could dissolve like salt in water. He watched it happening. He watched the German mark become nearly worthless. He watched savings evaporate like morning dew. He watched widows clutching bundles of banknotes that could not buy a loaf of bread. In those years, Max worked behind scenes that history largely forgot to illuminate. He advised on currency stabilization. He consulted with politicians who barely understood what they were being told, but recognized that Warburg Co. represented something ancient, something that had survived other upheavals. The bank itself was a kind of currency now, a symbol that order, prudence, and continuity might yet be possible. There were moments when this seemed almost plausible. The Dawes Plan of 1924, which restructured German reparations into something potentially manageable, felt like breathing room. For a few years in the mid-20s, Weimar Germany experienced what historians would later call a golden interlude. There was culture blooming in Berlin. There was commerce flowing again in the ports of Hamburg. There was the fragile, tentative sense that perhaps the nation might yet recover. But Max Warburg was not a man given to illusions, and the interlude was far too brief. By the late 1920s, the cracks in the edifice had become impossible to ignore. The American stock market, that gleaming temple of infinite growth, was beginning to show signs of trembling. And Max, who had cousins in New York, who understood the mechanics of international finance as few men did, knew that when Wall Street fell, the impact would ripple backward across the Atlantic with the force of a tidal wave. The Warburg family itself had become something more dispersed, more internationally woven. Felix Warburg's branch in New York was now established, prosperous, integrated into the highest circles of American finance. Paul Warburg, who had helped architect the Federal Reserve, was somewhat removed from daily banking now, but his influence lingered like the scent of old leather and paper in a library. In Hamburg, Max held the center. In Hamburg, he was not merely a banker but an institution, a man whose steady presence seemed to anchor something in the chaos. But there was another current moving beneath all of this, a current colder and darker than any financial crisis. It moved quietly at first, almost imperceptibly, through the beer halls and the political meetings and the anxious dinner conversations of Hamburg's merchant class. The National Socialist German Workers' Party was growing, gaining coherence, beginning to speak to fears and resentments that the golden interlude of the mid-20s had merely papered over rather than healed. There were pamphlets being distributed, there were speeches being given, there were, increasingly, references to those who had supposedly caused Germany's downfall, those who profited from others' misery, those who were not truly German. What is the relationship between economic despair and the scapegoating of minorities? History would ask this question many times, but Max Warburg was beginning to feel its answer not as an abstraction, but as a tangible coldness in the air. He was a man of the Jewish faith. His family had lived in Hamburg for centuries. They had been merchants and citizens and advisors to princes and leaders. They had woven themselves into the fabric of the city so completely that it seemed impossible they could ever be regarded as anything but German. Except that the equation was beginning to change. The logic was beginning to shift. And the shift was happening not in the grand salons of high finance, but in the taverns, in the streets, in the growing conviction of ordinary people that their suffering had a cause and a face. In 1929, the American stock market collapsed, and the economic earthquake that Max Warburg had quietly feared began to unfold. Germany, which had become dependent on American credit and American investment, was suddenly cast into darkness again. Banks failed, unemployment rose, hunger returned, the golden interlude evaporated like morning dew under a harsh sun, and in that darkness, certain voices grew louder, more insistent, more persuasive. Max Warburg continued his work, but it was now work conducted in an atmosphere of gathering dread. He was not a man prone to panic, but he was not a fool either. He could read the currents. He could sense the direction in which things were moving. The rise of the National Socialists through the early 1930s was not merely a political phenomenon, but a personal threat, though it took time for that recognition to fully crystallize. After all, he was not a political man. He was a banker. Surely reason would prevail. Surely the institutions would hold. Surely the fact of his family's centuries in Hamburg, their contributions to the city, their standing among the merchant class would count for something. But institutions, as it turns out, are far more fragile than they appear when viewed from positions of stability and respect. And reason, when it comes into direct competition with fear and resentment and the intoxication of promised solutions, is often an inadequate defense. By the early 1930s, Hamburg itself was becoming a different place. The Warburgs, who had seemed so permanently embedded in its life, were beginning to acquire a kind of precariousness. It was still unspoken, still deniable, still something that respectable people in respectable circles pretended not to notice. But it was there, in the air, like the smell of smoke before you see the fire. Max Warburg, that steady, careful banker who had spent the previous decade trying to hold his nation together, now found himself facing a question he had never imagined he would need to contemplate. What does a man of honor do when the institutions he has served, the nation he has served, begins to regard him not as a citizen, but as an enemy? What does he do when the city he loves transforms, gradually but inexorably, into a place where his presence becomes unwelcome? The answers would come, but they would come slowly, painfully, carried on a wind that no one could yet hear, but that would soon blow across all of Europe with hurricane force. The year was 1933. In Hamburg, where the Warburgs had built their name across nearly 2 centuries, the fog came rolling in from the Elbe, as it always did, but something had shifted in the air that winter. The banks that had weathered the crash of '29, that had survived wars and depressions, now faced a different kind of pressure. Not the market's blind machinery, but the deliberate turning of policy and opinion against them. Max Warburg, now in his 60s, a man who had stood beside chancellors and princes, who had been awarded honours by the Kaiser himself, received a quiet suggestion. Perhaps it would be wise to step back from active management of the bank. Not a demand, not yet. A suggestion, wrapped in words about new leadership, fresh directions. But everyone understood what it meant. The family had watched the rise of the National Socialists with growing dread, as one might watch storm clouds gathering on a distant horizon, knowing intellectually that they will arrive, but not quite able to grasp the full force of what's coming until the rain begins to fall. Max's health was fragile, and he was tired in a way that went beyond age. His brother Paul, by then in his 70s, had long since removed himself to America, where he died in 1918, spared, in a sense, from witnessing what his beloved Germany would become. But Max remained in Hamburg. Fritz remained. The younger generation remained, many of them with children now, with roots and businesses and civic investments that went generations deep. The dispersal did not happen all at once, the way a scattered seed pod releases its seeds to the wind. It was gradual, reluctant, each departure a small dying of something cherished. Max Warburg held on as long as his body allowed, his mind still sharp, but his authority increasingly irrelevant. The bank itself, the Warburg Bank, the institution that had been the family's identity for so long, began to lose access to the international credit lines that had once flowed so naturally. Clients quietly withdrew deposits. Foreign connections were discouraged or severed entirely. By 1938, it became clear that remaining was no longer a choice, but a dangerous fantasy. What does a family do when the place that made it no longer wants it? When the institutions that granted you respect and position and livelihood have been instructed, from the highest levels of state power, to regard you as something less than fully human? There is a peculiar horror in this kind of expulsion, because it is not always violent at first. It is bureaucratic. It is the slow closing of doors, the absence of phone calls, the way colleagues you had known for decades suddenly become unavailable. It is the law revised to exclude you. It is the knowledge that resistance is futile, that you have no allies in power, that your only hope lies in leaving everything behind. Max Warburg left Hamburg in 1938, at 75 years old. He travelled first to Sweden, then to New York, where he would spend his final years. To give up the bank he had led, the city he had helped shape, the name he had carried with such weight and purpose, was to step out of his own life. He died in 1942, never returning to Hamburg, the city whose fog and canals had been the substance of his entire existence. One wonders whether, in his last years in exile, he dreamed of the Elbe, whether he woke in the dark remembering the weight of the bank's ledgers, the faces of employees he had known since they were young men, the weight of being not only a banker, but the symbol of his family's continuity. The others followed in different directions, as if scattered by a wind that blew from Europe toward every safe harbour the world could offer. Some went to New York, where the Warburg name was already woven into the fabric of American finance through Felix's long residence and his work with Kuhn, Loeb. The New York banking world received them as exiles and refugees, but also with a certain gratitude. They were, after all, people who understood international capital, who could help navigate the financial chaos that Europe's collapse was creating. Others went to London, where the Bank of England and the city were more accustomed to receiving displaced financiers and princes. Still others scattered to the margins of safety, Palestine, South America, wherever an ancient name and a passport might offer shelter. The Hamburg Bank itself did not survive intact. It was absorbed, or perhaps the better word is conquered, into the new financial structures that the Nazi regime was constructing. The physical building remained, of course. Buildings are harder to erase than people, but what it had been, what it had meant, was gone. The trust that Warburg had accumulated, brick by brick, relationship by relationship, over nearly a century, dissolved like fog in sunlight. To the new regime, the bank's Jewish ownership and international connections were not assets, but stains to be scrubbed away. It is worth pausing here to consider what was lost in this dispersal. Not merely money, though the family's assets were certainly frozen, seized or abandoned. Not merely position and influence, though those too vanished. What was lost was continuity. The expectation that the next generation would inherit not just a bank, but a tradition, a role, a way of being in the world. The Warburg children, who had grown up, assuming they would expand their parents' legacy, instead found themselves refugees, starting over in middle age, their children's education interrupted, their family narrative severed. And yet the family did not disappear into the refugee camps and scattered exile of so many others. The dispersal, as painful as it was, preserved something. The Warburgs had learned over generations how to survive instability. They had capital, yes, but more importantly they had knowledge and connections that were portable. A banker's mind cannot be seized. A reputation for trustworthiness and competence cannot be erased by a signature on a law. These things traveled with them to New York and London and beyond. In America, the Warburg name acquired a new kind of weight, burdened by tragedy but also brightened by survival. Paul Warburg had shaped the Federal Reserve decades earlier, and though he was long dead, the architecture he had helped design stood firm. The Warburgs who arrived in America in the late 1930s were not starting from nothing. They were threading themselves back into a financial system that had, in many ways, been shaped by their family's thinking. It was not a homecoming, because Hamburg was that, and Hamburg was lost, but it was a kind of return, a reconnection with work, interrupted by an ocean and by history. The experience of exile changed the family in ways that the letters and business records preserve only faintly. There is a photograph from 1941, I think it is, of Max Warburg in New York, an old man in an American suit standing on a street somewhere in Manhattan. He looks composed, but there is something in his eyes that speaks to the weight of translation, to the exhaustion of starting over when one's muscles have already spent a lifetime building something else. How does one explain to people who have never been displaced what it feels like to lose your city, your bank, your life's work, all simultaneously? Perhaps one doesn't explain. Perhaps one simply finds work and builds forward and carries the loss quietly, as people do. The Second World War, when it came fully, separated the family still further. Some Warburgs would contribute to the war effort from America. Others would find ways to help Jewish refugees escape Europe. The bank of which they had been so proud became a symbol of everything they had lost. But the family itself, the network, the knowledge, the quiet determination to persist, this became stronger through dispersal, as if exile had revealed what had always been essential about them. They were not merely Hamburg bankers. They were something more portable, more resilient. They were a family that understood how to navigate between worlds, how to preserve what mattered while releasing what was temporary. By the time the great banking houses of pre-war Europe had all but vanished into memory or transformation, the Warburg name had already begun its quiet migration into the fabric of modern finance, not through dominance or spectacle, but through the very patient work of people who had learned, across centuries and continents, how to survive by understanding the invisible currents that move capital and trust through the world. The family that had weathered the Hanseatic storms of the 17th century, that had built their ledgers in an age when a merchant's word was his bond, had now learned another kind of endurance, the art of beginning again, of carrying knowledge and instinct forward across an ocean, across loss, into a future they could not predict. Max Warburg, who had guided the Hamburg Bank with such steady wisdom through the twisted years between the wars, spent his final decades in exile, first in Sweden, then in New York, consulting quietly, his counsel sought by those who remembered his voice from before the darkness. He died in 1953, in America, a man who had lost his life's work, but never his capacity to think clearly about money and trust. Paul Warburg's legacy proved more durable in institutional form. The Federal Reserve System he had so carefully explained to skeptical senators and doubtful journalists, that strange hybrid creature that was neither wholly private nor fully public, neither a European central bank nor an American political instrument, endured. It evolved, it was reformed and reformed again, but the essential architecture he had helped draft remained. And so, in an odd and unbounded way, his influence continues to move through the American economy to this very moment, embedded in decisions made by governors and presidents, in the mechanics of discount windows and open market operations, in the very idea that a nation's money supply ought to be managed with care and foresight, rather than left entirely to the whims of circumstance or political expedients. One might say that whenever a Federal Reserve chairman speaks to Congress, or a rate decision ripples through the global markets, Paul Warburg's ghost is there, not as control, but as thought. Yet the deeper legacy of the Warburgs may be something less tangible and perhaps more profound. It is the legacy of a family that understood, in their very fibre, how knowledge itself is a form of capital, how a careful mind trained in the workings of commerce, how a reputation built slowly through honesty and judgment, how the ability to move fluidly between cultures and languages and systems of thought, these things could survive when empires could not, when banks could be seized and fortunes could disappear overnight. The Warburgs taught their children to learn. They taught them languages. They taught them to observe how different peoples and nations approached the question of how to exchange value fairly. And when exile came, when the world they had known in Hamburg was violently erased, that portable form of wealth, that inner capital, was what they could carry with them. Felix Warburg, who had taken the family's name into the American establishment through his marriage to Frieda Loeb, through his partnership in Kuhn, Loeb & Co., through his philanthropic work and his quiet influence on American Jewish institutions, Felix had built a bridge. His children and grandchildren would move further into American life, into law and medicine and academia, their Warburg identity becoming one thread among many in their sense of self. And yet there remained a kind of consciousness, a memory of where they came from, what their family had accomplished, what they had lost. This consciousness itself became part of the inheritance. In the decades after the Second World War, as the Federal Reserve matured and the American financial system consolidated around the model Paul Warburg had helped envision, a quieter narrative unfolded. The bank in Hamburg was rebuilt, transformed into a different institution entirely, its records preserved, but its continuity broken. The great merchant banking houses of Europe underwent their own metamorphosis, merging and adapting to new realities. The Warburg name appeared in various financial institutions, a bank here, an investment firm there, sometimes connected to actual descendants of the original family, sometimes simply borrowed from the dust of history. Warburg Pincus, a venture capital firm founded by and named after one of the Warburgs, became a major force in modern finance, directing capital toward new technologies and enterprises yet unimaginable in Paul Warburg's time. And in the academic world, the Warburg name lives on as well, in libraries and institutes, in the work of scholars studying art, history, economics, always asking the question, how do we understand the movements of culture and commerce across time? What makes the Warburg story resonate, perhaps, is not any single achievement, though their contributions to central banking and modern finance were substantial, but rather the pattern of their presence. Presence in crisis, presence in transformation, presence in the spaces between the known world and the emerging one. They were never the loudest voices in the room. They preferred to consult, to advise, to work through others, but they were there, at the moments when systems had to be rebuilt or reimagined, and they carried with them the knowledge of previous systems, previous adaptations, the memory of how to survive discontinuity. Consider the deeper irony embedded in their story. A family of Jewish merchants, persecuted and expelled from many lands across centuries, eventually found themselves in a position to shape the monetary architecture of the world's most powerful nation, not through imperial conquest or political force, but through the slow accumulation of knowledge and the patient building of trust. And then, in the moment of their greatest security in Hamburg, all of it was threatened by hatred and violence. Yet what they had built, not buildings or banks, but understanding, networks, ways of thinking about complexity, proved more resilient than the physical structures that housed them. The knowledge migrated. The relationships, strained but not entirely broken, continued in new forms. When historians and economists look back at the formation of the Federal Reserve System, they often focus on the political drama and the ideological debates of the day. But threaded through that public narrative is the quieter story of a man named Paul Warburg, an immigrant, a banker, someone who had seen how another civilization organized its financial system and brought those insights to bear on a new world that needed them. He could not have done it alone. He worked with others, convinced others, adapted and compromised and persuaded. But his particular angle of vision, informed by his family's long experience of moving between worlds, of understanding different languages and systems simultaneously, mattered. It is tempting to imagine that the Warburgs knew, in some prescient way, that their story would become historically significant. But the evidence suggests something else, that they simply did what thoughtful, well-educated, ambitious people do when they are given the opportunity and the responsibility. They worked, they studied, they built, they adapted, and when the world changed around them in ways they could not control, they carried forward what was most valuable about what they had learned. The family's dispersal across continents, to New York and London and Cambridge, to Tel Aviv and beyond, meant that the Warburg consciousness became pluralistic, fragmented, refracted through different national traditions and personal circumstances. There was no single Warburg legacy anymore, but rather a constellation of legacies, each one shaped by the particular exile or migration or adaptation that defined that branch of the family. And yet, if one listens carefully to the conversations and the writings and the work of the Warburgs and their descendants across the 20th century and into our own time, there is a recognizable tone, a certain evenness, a certain patience, a certain conviction that complexity is not to be feared but studied, that culture and commerce and human nature are deeply interconnected, that the work of understanding how systems function is fundamentally a work of translation, of moving between languages and perspectives. Perhaps this is the truest legacy of the Warburgs. Not any single institution or policy, though those matter, but rather the model of how a family with deep roots in one place could, when forced to leave that place, transform their displacement into a kind of intellectual and relational wealth that multiplied rather than diminished as it dispersed. The Warburgs could not stay in Hamburg. History did not allow it, but they could go forward, and they did, carrying with them the conviction that knowledge and understanding and the capacity to think across boundaries could always find a place, would always be needed, could always be offered in service to something larger than the particular loss they had experienced. And so the fog that rolls across the canals of Hamburg in the evening light, the gaslight reflecting on water, the image with which this journey began, belongs now to history, to memory, to the careful work of scholars piecing together a world that no longer exists. But the questions the Warburgs asked, how should a nation manage its money? How should we understand the relationship between trust and value? How do we build institutions that last? Those questions remain alive and urgent, moving through the financial systems and the economic institutions of the world they helped shape, continuing to resonate in quiet ways that the family themselves might well have recognized, had they lived to see the centuries unfold beyond their own time.